Good evening, everyone, guys. So let us start with the next topic, income from other sources. Am I audible to everybody? So income from other sources, we understand it is from section 56 to 59. 56 is the charging section. Thank you, Rajalakshmi. 56 is the charging section for IFOS. 57 is deductions which are allowed under IFOS. 58 is deductions not allowed. 59 is deemed IFOS. See, 59 you will not get, 58 you will not get, but 56 and 57 is something which is important. So section 56 says, let me talk about specific income which are taxable under IFOS. Dividend income is always your IFOS income, whether it is deemed dividend also. So I'll be telling you what is deemed dividend. Although we have done in capital gain 222F is one of the deemed dividend. Today, on or after 1st October 2024, when the shares are bought back. So whenever the amount which we receive for shares, that is a deemed dividend under section 222F, it would be IFOS income. Other dividend is also again IFOS income. Dividend income is IFOS, casual income is IFOS, gifts is your IFOS income, but it depends at from where we are getting this gifts. If these gifts are we are getting from our employer, it becomes our salary income. If these gifts we are receiving from our in the course of business or profession, it becomes PGBP income. But if it is other gifts which we receive from our friends or relatives, in that case, these gifts are taxable under IFOS. But we know that gifts from relatives are exempt. I'll be talking about that as well. Uh, any sum of money or property received without consideration or inadequate consideration, it is also a gift which we receive any money or other property as a gift. That is again taxable under IFOS. Interest received on delayed compensation. You understand whenever the asset is compulsory acquired and we receive compensation would go in your capital gain, but interest on delayed compensation, it is IFOS income. And please do remember that 50% is the flat deduction that you have to give from such interest. Advance money forfeited, and you now know that any advance money which is forfeited on or after 1st April 2014, not very important to remember this date, but yes, today whenever the advance money is forfeited, please make it IFOS income in that very year. So let's say tomorrow in your examination in the previous year 24 25, anywhere in between, if we are forfeiting any advance money, straight away make it your IFOS income. Correct? Renting of plant and machinery or renting of first of all, renting of building. No, renting of plant and machinery or furniture. See, if you are into a business of renting of plant and machinery, then it is your PGBP. But if it is you are not into business, but you let out your plant, your machine, your furniture, that will be IFOS income if you are not into business of it. So if it is not chargeable to PGBP, so whenever you rent your plant and machinery, renting of building. Why renting of building is written over here? Because renting of building is generally house property. But I have told you in house property, whenever you rent your building with other assets, and it is not separable, we cannot separately let it out. Other assets, we cannot let it out separately. In that case, the entire rent will become IFOS income. Correct? Any expenses can be allowed as deduction as a normal deduction under IFOS. But yes, renting of building, which is not separable, it will become your IFOS income, right? And first of all, let us understand the taxability of gifts. See, again, I'm telling you, if you are receiving gifts from your employer, it is salary income. It is salary income. Let me again revise about this one because I have not covered this gifts and salary chapter. See, whenever you receive gifts, if it is from your employer, then it is your salary income. Correct? And under salary, it depends that if you are receiving these gifts in the form of cash means in the form of money, then 100% is taxable. Everything is taxable. Please make it taxable. However, if you are receiving these gifts in the form of kind, let's say your employer is giving you a mobile phone as a gift or laptop as a gift, it is in kind, and the total value of it is if it is up till 5,000, you can ignore, that is exempt. but it is exceeding 5,000, then make it taxable. So let's say in aggregate in a year, if you are receiving gifts from your employer, it is salary income, of course. Cash gift, whether it is 5,000, less than 5,000, doesn't matter. Each the monetary gifts from the employer, it is taxable as bonus, so it is 100% taxable. If it is in kind, then up, if the total value of the entire year, the aggregate of all the gifts, if it is up till 5,000 rupees, then it is exempt. If it is more than 5,000 rupees, so let's say the aggregate of in-kind gift, it is 6,000. So you have two options. Either you can make 6,000 entirely taxable, or some students can also do like this, that initial 5,000 is exempt, in excess of 5,000 is taxable, 1,000 is taxable. Both are correct. Both the provisions are correct. If you want to make it entirely taxable, let's say it is 6,000, 7,000, make it entirely taxable. That is also correct. In excess of 5,000, that is also correct. I would recommend, please make it fully taxable. Please make it fully taxable. Understood? So this is if this gift is from the employer. Second, if these gifts are from your, let's say, in the course of business or profession, if it is in the course of business profession, so any gift which you receive in the course of business and profession, it is fully taxable under section 28 PGBP. But if these gifts are other gifts, if these gifts are received from others, then it becomes IFOS income. But you understand, only those gifts in would be covered under IFOS which are capital asset in the hands of receiver. If they are capital assets in the hands of receiver, let's say if you are getting a gift of jewelry, archaeological collections, paintings, drawings, sculptures, or land and buildings, security, shares, etc., then please make it taxable. If let's say the asset which you are receiving is not a capital asset, for example, you are receiving mobile phone, you are receiving laptop, you are receiving any other thing which is not a capital asset, under IFOS, please don't make it taxable. It is fully exempt. Understood? From anyone you can receive. See, in salary, you can receive any type of gift, any type of gift. Here, I am not using the word capital asset. Here, I am not using the word capital asset. I'm using the word capital asset only over here. So under IFOS, whenever you receive the gifts, it should be a capital assets in the hands of receiver. Got it? So now, does it over here? No. Okay. Now, first of all, now it depends that what kind of gifts you are receiving. If you are receiving cash gifts, movable gifts, immovable gifts, you have to make three things. You have to segregate. In fact, you don't have to segregate it really, but in your mind, you should segregate it, that what are the cash gifts, what are the movable gifts, what are immovable gifts. These movable gifts should be capital assets. If they are not capital assets, please don't make it taxable first of all. Let me talk about cash gifts. Just aggregate the cash gift which you receive. Thus, just aggregate all the cash gift which you received. And if the aggregate exceeds rupees 50,000, then it becomes fully taxable. Let's say if it exceeds 50,000, let's say it is 51,000, then entire 51,000 will become your IFOS income. Got it? Second thing, if you are receiving movable gifts, now it depends that whether you are receiving movable gifts without consideration or inadequate consideration. What is inadequate consideration? When you purchase at a lesser value, at less value when you purchase it, that is called, that is also covered as a gift. Although it is a kind of purchase, whenever you purchase your capital assets at a lesser value, it will again be taxable. So whatever the amount which you are paying less, it will become taxable. But first of all, if you are receiving any capital asset, that is movable capital asset, for example jewelry, for example shares, for example any other archaeological collections, painting, etc., if you are receiving those, and just aggregate the all the gifts which you are getting from friend number A, from friend number B, from friend number C, just aggregate in the entire year. If the total fair market value of such gifts exceeds 50,000, then please make it taxable. Cash gift, please keep it separate. Movable gifts without consideration, keep it separate. Correct? Then, if you are purchasing at a lesser value, so let's say if you are purchasing shares, if you are purchasing jewelry, if you are purchasing any other capital, you are purchasing gold, you are purchasing any capital asset that is movable at a lesser value. So, whatever is the difference, if this difference exceeds 50,000 rupees, then this difference will also become taxable. So what you need to do is, if you are purchasing anything at a lesser value, aggregate of all such gifts, the fair market value, just aggregate it. How much is the fair market value of all these gifts minus the consideration paid? So if this difference exceeds 50,000 rupees, then make it fully taxable. Got it? How do you actually get it in your examination? Generally, you get one question that is of capital gain also or IFOS also. For example, let's say, don't write it, just understand this. This is an important question which generally examiner keeps on giving it to you. For example, Mr. A, he has purchased, let's say he has purchased 1000 shares of ABC Private Limited at a rate of 20 each, correct? And he sold it to B. Let's say he has sold it to B at a rate of rupees 50 each. And the fair market value on this date, let's say it was rupees 80. Let me make it 10,000 shares, right? So the fair market value is 80 rupees. Now you have to compute the capital gain or IFOS income of A and B. So first of all, A, in the hands of A. So he's selling the shares. What kind of shares which are getting sold? This is ABC Private Limited. These are unlisted shares which are getting sold. So first of all, full value of consideration. Although he's selling it as at 50 rupees, but you understand that there is a section 50CA. There is a section 50CA which tells you that whenever unlisted shares are sold, and if the fair market value is more, then we will take it the fair market value. So here fair market value is more than the actual selling price. So you will sell it at 80 minus cost of acquisition. Cost of acquisition is 20. So 60 would be the capital gain on one share. It depends. If it is more than 2 years, then it is long term. If it is less than 2 years, if it is less than 2 years, then it would be short term. So 60 into 10,000. So let's say 6 lakh. I believe 6 lakh it is. Short term capital gain, long term capital gain, whatever it is, it depends on the period of holding. Correct? So 6 lakh would be the capital gain in the hands of A. Similarly, in the hands of B, now what he is doing is he is actually purchasing these shares. The fair market value is 80 rupees. So he is purchasing at a lesser value. The fair market value is 80 minus the amount which he is paying for this. The purchase price is 50 rupees. So on every share, he is getting a benefit of 30. And 10,000 shares we have. So it means 30 into 10,000. It is how much it is? 3 lakh. So 3 lakh, this difference is exceeding. This difference is it. See why I'm saying difference? 80 minus 50, 30 into 10,000 shares. So this difference is exceeding 50,000 rupees. So this is also will become IFOS income. So this is an important question which examiner keeps on giving it to you. So in the hands of A, it would be capital gain. In the hands of B, it would be IFOS income. So whenever you purchase an asset, capital asset at a lesser value also, it will become your IFOS income. Got it? Next. And please remember, I've already told you that only the capital assets are considered under movable gifts. If such movable gifts are not capital asset, then it is not taxable. So if you are receiving car, if you are receiving, let's say a bike, if you are receiving mobile phone, you are receiving laptop, please don't make it taxable because these are not capital assets in the hands of receiver. Jewelry is a capital asset, but let's say the person who is purchasing it is a jeweler. So please tell me, for a jeweler, jewelry is a stock in trade. It is not a capital asset. Then please do not apply that section in the hands of jeweler. So you should understand it should be a capital asset in the hands of receiver. Then only you will make it taxable. I believe everybody is clear on this. If you want me to explain more, please let me know. Then immovable gifts. If you will receive immovable gifts. So let's say if you receive immovable gifts without consideration and the stamp duty value is more than 50,000 rupees, please make it taxable. Guys, there is one difference over here. In cash gift, movable gift, you have to do the aggregate. But in immovable property, you don't have to give the do the aggregate. You have to take each individual property separately. So you have to see the stamp duty value of each property. So let's say there is property A, there is property B, there is property C, which you are getting without consideration as a gift, which you are getting. So property A stamp duty value is, let's say 5 lakh. Property B is 45,000. Property C is 50,000. So we don't have to do the aggregate, or in case of immovable property, we have to see each property separately. So here C and B, the aggregate, the each individual stamp duty value is not exceeding 50,000, don't tax B, don't tax C. Property A will be taxed by because the stamp duty value is more than 50,000 rupees. Got it? So without consideration, please see the stamp duty value. If it is inadequate consideration, what is inadequate consideration? You are purchasing the property at a lower price. I was telling you in your IFOS chapter that this is the conversion of black money into white. So I'm not going into that right now. But please remember that whenever you are purchasing the property at a lesser value, then also please make it taxable. If the difference is exceeding 50,000 rupees, then please make that difference taxable. Also, please remember that in 50, there is actually, we will give you a benefit of 10% also, because in 50C we have seen that if the stamp duty value is more than 110% of actual selling price of the selling price, then we take stamp duty value. Otherwise we take the selling price only. It means that up till 10% difference is admissible. What does it mean? It means that, let's say Mr. A has purchased, let's say, a building, land or building for rupees 30 lakh, and he's selling it. Now he's selling it to B. He's selling it to B for rupees, let's say, 80 lakh. Correct. And on the date of sale, the stamp duty value is rupees, let's say, 85 lakh. Got it? So now my actual selling price is 80, my stamp duty value is 85. So first of all, how we will calculate the capital gain in the hands of A, because he's selling his land and building. It would be a capital gain in the hands of A because he's selling it. So how we'll do it? We'll do the fair full value of consideration. Stamp duty value is not more than 110% of the selling price, because the selling price is 80. 110% will become 88. But my stamp duty value is 85, which is not more than 88. So we will say 80 lakh is a correct value. So we will give the advantage to the assessee up till 10%. So full value of consideration, we will take 80 minus cost of acquisition, we will take 30. 50 lakh would be the capital gain. That is okay. But now in the hands of receiver, let's say now you have to calculate in the hands of B, because B is purchasing a immovable property at a lesser value. How much? See, if you will ask me, the stamp duty value is 85. The stamp duty value is 85 minus, and how much he is purchasing it for? 80 lakh. So the difference is 5 lakh, which is exceeding 50,000 rupees. So we can say that let us make it taxable as IFOS. But in case of immovable property, we will see 50,000 also, but we will see 110% also. So we will see that whether the stamp duty value is exceeding 110% of the purchase price. Here we can say purchase price. The answer comes no. It means that here we will, although the difference is 5 lakh, although the difference is more than 50,000, but it is not, the difference is not exceeding 10%. The difference is not exceeding 10%. So we will give the benefit here also. So we will make IFOS income as 0. We will say no, although it is exceeding 50,000, but there is one more limit over here. We will see 10% also. So I can say that if we have given the benefit of this to the seller, we will also give the benefit of this to the purchaser. Everybody okay with this? So in this case, we have to give the benefit to the purchaser also. So please do remember, in case of immovable property, 50,000 is also the limit, and also 110% of the selling price is also the limit. So 10% is also the limit. So if it is not exceeding 10%, we are okay with it. We will not make it IFOS income. Anu, for movable gifts, only for immovable you will see separately, but for movable you will do the aggregate. For movable you will do the aggregate. Got it, Anu? Okay. And now, second thing is that this stamp duty value you have to take at the time of registration. But again, if there is a prior date agreement, assessee is saying, no, sir, actually I have not purchased it at a lower value. Actually, we have a prior date agreement, and I have also paid to him at that particular time in the form of banking mode. then please don't take the stamp duty value of this date today. Please take the stamp duty value of that prior date agreement. The same thing will be applicable over here. Whatever we have seen in the chapter of capital gain, same thing would be applicable. So stamp duty value would be actually the stamp duty value on the date of purchase. But sometimes we can take the stamp duty value of the agreement date also if there is a prior date agreement, plus at least some consideration you have paid by a banking mode. Understood? Okay. Now, the following gifts will be exempt. The following gifts would be exempt. What kind of gifts would be exempt? If you are receiving it from relative, that is important. If you are receiving from relative, that is exempt. Who is the relative? Spouse of the individual. So if you are receiving from your spouse, the assessee is receiving from the spouse, that is a relative. It will not be taxable. Brother and sister of the individual, we can receive it from our own brother or sister. We can also receive from the brother and sister of the spouse. So who are the brother and sister of the spouse? They can also give us gift. That is also not taxable. Brother and sister of either of the parents of the individual. So our father, brother and sister, or our mother's brother and sister can give us gift. No need to worry. Any linear ascendant or descendant of the individual. So the assessee can receive gift from his children, grandchildren, parents or grandparents. You can receive it. Any linear ascendant or descendant of the spouse of the individual. So from father-in-law, from mother-in-law also we can receive the gift, right? And spouse of the person referred above. So let's say we can receive the gift from our brother and we can also receive the gift from our brother's wife. We can receive the gift from our sister and we can also receive the gift from our sister's husband. Got it? Okay.
அப்படியா? இப்போ ஆமாமா.
Okay. Now, from relatives, the gifts are exempt. On the occasion of marriage of the individual, see, if it is individual marriage, bride or bridegrooms, it is they are receiving gifts, then it is exempt. But if their father is receiving gift, if their mother is receiving gift, it is not their marriage, so it would be taxable there. Under a will, it is will. Under a will or by way of inheritance, if you receive gift, then it is exempt. From a local authorities, it is exempt. From any fund or foundation or university or any trust or institution registered under section 12a, the section number is not that important, but please remember that if you are receiving gift from a local authority, if you are receiving gift from any uh, religious or charitable institution which is registered, or any fund or foundation or university which is registered or it is approved, then you can receive the gift from them. It is not taxable. So this is a little bit important. Sometimes they ask you, it will come as one of the part of the question, so it would hardly be for 1 mark. But please remember, if you receive any gift from local authority, from any fund, foundation, university, from any institution registered under section 12ab, section 12ab is not important, but yes, any registered institution or charitable institution, please make it exempt. COVID related exemption is not that important. Okay. Deductions allowed under IFOS. This is the second section which is important in IFOS. From dividend income, this is an important point. See, dividend income is a IFOS income. The only expense which can allowed from dividend income is the interest on loan. So if you have actually purchased the shares and for purchasing the share you have taken a loan, then that interest is allowed, but maximum whatever is the interest which you are paying on that loan, or 20% of the dividend income, 20% of the dividend income, whichever is lower. So maximum deduction which you can get is 20% of the dividend income. So 20% of the dividend income. I believe that you are able to remember this, guys. Right? No other deduction from dividend is allowed. So if there is any bank collection charges, any other charges, please don't allow it from the dividend income. Only the expense which is allowed is interest on loan, that too maximum 20% of the dividend income. Family pension is important, and there is a little amendment also in case of default regime. Whenever we receive family pension, see, whenever the employee receives pension, it is his salary income, correct? And regular pension, you understand, it is fully taxable. But if the family member are receiving the pension, then also it is taxable under IFOS. And from that family pension, there is a flat deduction, one third of such pension, or rupees 15,000, or rupees 15,000 or 25,000. So it depends which regime you are following. If you are following default regime, then please take 25,000. If you are following optional regime, take 15,000. So one third of such pension, or 15,000 or 25,000 as the case may be, whichever is lower, that is exempt. Family pension is important. Interest on delayed compensation, you all know, 50%. Post office saving account interest, very, very important. One of the favorite of examiner, they keep on giving you this. Interest on post office saving account. See, please remember post office saving. So from it, there is a flat deduction exemption of 3,500. So 3,500. So whenever you receive post office saving account, so in IFOS income, please make it taxable after deducting 3,500. So for example, if somebody is receiving post office saving account interest, for example, 15,000 rupees, please first of all make 3,500, deduct 3,500 from it. Whatever it remains, I believe 11,500. Please make it 11,500 as your IFOS income. Correct? And since it is a saving account, if the person is following optional regime, then also please remember 80 TTA or TTB as the case may be. TTB in case of assessee is a senior citizen, then TTB, otherwise TTA if the assessee is following optional regime. In default regime, there is no such TTA or TTB. So please, I want you to remember post office saving account is not any post office time deposit. Please remember it is post office, that to saving, only for saving. If it is any other deposit, then there is no such thing of 3,500. Only, again, I'm repeating, post office plus saving, 3,500. If it is a joint account, then it is 70. It's not 7,500, it's 7,000. It is double, 7,000. Joint account, generally you will not get, you will get this 3,500. So please give 3,500 exemption, both under default regime as well as optional regime. So while computing your IFOS income, simply deduct 3,500 in case of a single account. If nothing is mentioned, take it 3,500. If it is joint account mentioned, take it 7,000. And in case of any other IFOS income, all expenses can be allowed. So let's say if the assessee has given a furniture on rent, for example, and renting of furniture is not his business. So he has just given furniture on rent to someone. So that income is IFOS income. But in that case, if he is incurring any expenses, let's say repair of furniture or any other expenses, that can easily be deducted. From casual income, no expenses can be deducted. Casual income is 100% taxable. 30, it is taxable at rate of, and the tax rate is 30%. But from casual income, you cannot deduct any expenses. Even if your examiner will say that the assessee has won a lottery of rupees 1 lakh and he has actually purchased a ticket of 1,000 rupees, no, 1,000 deduction will not be allowed. Entire 1 lakh would be taxable in casual income. Section 58 is deductions not allowed. Not so important. Not so important. It is Rajalakshmi, TTA, I will tell you. Don't worry, I'll tell you in the chapter of deduction. See, section 58 says what are the deductions which are not allowed under IFOS. So any capital expenses is not allowed. Any personal expenses not allowed. Payment in cash more than 10,000 in a single date is not allowed. Payment to related party in excess of fair market value, same like PGBP. It is not allowed. Any amount paid outside India without TDS, 100% will be disallowed. Any payment made to a resident on which TDS was required to be deducted, if you have not deducted it, 30% will be disallowed. And no deduction allowed from casual income, that we have already done. Section 59 is not important. What it says, it is deemed IFOS. Any expenses which we have claimed earlier, if we have recovered it, it is like bad debts recovery. So in PGBP, it is section 41. Here it is section 59. So if any expense we have claimed earlier in IFOS and now we are recovering it back, please make it IFOS income. Not that important. Sum received under LIC. See, if you remember, I have told you about high premium policy. If it is a high premium policy, then the sum received is taxable under IFOS. But if it's a low premium policy, then it is exempt. So what is a high premium policy? See, you just have to remember this date. I have told you in classes that please remember just this date, 1st April 2012. So if there is any policy before this date, then you have to take 20%. So if the premium paid is up to 20% of the sum assured, then it is a low premium policy. Then please make it exempt. But if the premium paid is more than 20% of the sum assured, then it is a high premium policy, and such amount which you receive is taxable under IFOS. Second thing, see, before 1st April 2012, it is 20%. For next 1 year, it is 10%. From 1st April 2012 till 31st March 2013, it is 10%. So you don't have to remember this date. Just remember this date and build your own story. So before 1st April 2012, 20%. For next 1 year, it was 10% for all policy. But after 1 year, they realized that those people who are physically handicapped, blind, deaf, or dumb, in that case, they have to pay higher premium. So after 1st April 2013, they made 10% or 15% for disabled. So 10% was also there, 15% is also disabled. And on or after 1st April 2023, 10% is also there, 15% is also there, and one more limit of 5 lakh is also introduced. So any policy which you have taken on or after 1st April 2023, if the premium is more than 5 lakh, it is a high premium policy. So whenever you receive the money of high premium policy, that is fully taxable. If it is a low premium policy, so how, first of all, identify whether it is a high premium policy or a low premium policy. If it is a high premium policy, then it will become IFRS income. If it is a low premium policy, then it is exempt. Got it? Deemed dividend 222. In fact, 222F we have done in case of buyback of shares. 222E is the one which is important. 222E. What does 222E tells you? It is only on private companies or unlisted companies, I can say. So let's say there is an unlisted company, ABC Private Limited, and there are certain shareholders. Let's say there is a shareholder A, there is a shareholder B, there is a shareholder C. A has 60% shares, B has, let's say, 40, not 40, he has 35% shares, and C has 5% shares of this company. It's a private limited company or an unlisted company or a closely held company, whatever I can uh, call it. So if any shareholder who has 10% or more shares, who has 10% or 4 shares, so in this case, I'm talking about A and I'm talking about B, I'm not talking about C. On C, this provision will not be applicable. Why? Because he is not holding 10% or more share, he is holding less than 10%. So I'm talking about A and B. So if these shareholder take a loan from this company, whenever they will take a loan from this company, so whatever is the loan which they take, up to the extent of profit, it will become their deemed dividend. It will be taxable in the hands of A or it will be taxable in the hands of B, whosoever takes the loan. If C takes the loan, then this provision will not be applicable. It will not be deemed dividend income. It would not be IFOS income. But if A take a loan or B take a loan, then it will become their IFOS income as dividend. So let's say the company has a profit of, for example, 10 lakh. If any loan is taken by A up till 10 lakh, it will become his IFOS income. But if he is taking a loan more than 10 lakh, for example, A take a loan of 12 lakh rupees, then to the extent of profit, so to the extent of profit is 10 lakh. So if he is taking a loan of 12 lakh rupees, so up to the extent of profit that is 10 lakh, please make it his IFOS income. Correct? Same way, if B take a loan of 12 lakh, only 10 lakh will become his IFOS income. Got it? So just please remember this is a little bit important that whenever these shareholders who have 10% or more share, they take a loan to the extent of profit, it becomes their IFOS income. Whether they take a loan or any of their related party takes the loan or any other concern where they have the substantial interest. If there is any other partnership firm or any other business who takes a loan where such shareholder, either A or either B, have a substantial interest. What does substantial interest means? 20% or more ownership. 20% or more ownership. Please don't get confused with 10% and 20%. See, in our company, they have 10% or more share. Correct? In that particular business, which is taking the loan from this company, in that business, they have substantial ownership, 20% or more. Then also deemed dividend provision would be applicable on A and B. Correct? But this provision will not apply if the main business of this company is giving loan. If it is a banking company or they are engaged in giving loan, this is the kind of business, then this provision will not apply. Then please don't make it IFOS income. Got it? So this was about IFOS income. Agriculture income, which is earned outside India, it is taxable. If it is in Indian agriculture income, then it is exempt. If it is outside agriculture income, it will be taxable. Even if Bharti, even if the loan is repaid, nothing will happen. It will be your IFOS income only. So even on next day, if you repay the loan, this will not come, but still even of next day, if you will repay the loan, doesn't matter. Once it will become your IFOS income, it will be your IFOS income. Got it? Okay. Next chapter. Give me a moment. Next chapter is clubbing of income. See, it is clubbing of income. Whenever the person you would like to transfer his income, it will be clubbed in his hands. So if only the income is transferred to anybody without transfer of asset, you are not transferring the asset, you are just transferring the income. If you are just transferring the income, then clubbing provision will apply. Let's say if you have not, for example, you have debentures, and on debentures you are getting interest. So debenture is your asset. You have not transferred the asset, but you have instructed that the debenture interest will be transferred. So whenever the income is transferred without transfer of asset, it will become your, it will be added in the hands of the transferor. That is called clubbing. If the asset is transferred on revocable basis, let's say if you are transferring the asset also, but that too on temporary basis, then also the income will be clubbed. So whatever the income which is generated on that asset, that will be clubbed. Got it? So whenever you transfer your income without assets, or if you transfer your asset also but temporary purpose, revocable purpose, then again the income will be clubbed. If you transfer the asset on temporary basis, but it is actually a sort of permanent transfer. Why it is a permanent transfer? Because we cannot take it back up to the lifetime of the beneficiary. We cannot take it back up to the lifetime of beneficiary, then it will not be clubbed. So whenever you transfer your asset permanently, then there is no clubbing. Although spouse, son's wife, minor children case is different, but I'm talking about other people. If you transfer your asset permanently to someone, then in that case, there would be no clubbing. But if you transfer asset on a temporary basis, but it is a sort of permanent transfer, you cannot take it back until the lifetime of the beneficiary, then also there would be no clubbing. Got it? Then provisions related to a spouse. If spouse is earning any income, any remuneration, so if the spouse is earning any remuneration from a concern where the individual has substantial interest, let's say this is Mr. A and Mr. A has a business. Mr. A has a business, whether A is the owner of this business or A has substantial interest. Substantial interest means 20% or more ownership. So if an individual has a substantial interest in any business, 20% or more, even 20% will do, right? Less than 20% is not substantial, but 20% is substantial. Correct? Exact 20% substantial. So if A is having substantial interest in any business, and from this business, or from this concern, A's wife, Mrs. A, is getting salary, is getting any remuneration, she's getting any salary. If she is competent enough to get this salary, she is having adequate qualification, she's getting having adequate either experience or either skill, then we are okay. Then there is no clubbing. But in case she is not having any qualification, she's not having any experience, she is not having any skill for this job, then whatever is the salary fish she is getting, please make it taxable in the hands of Mr. A. Please make it taxable in the hands of A. And please remember what I have told you in the classes. Whenever the clubbing provisions will be attracted, then first of all compute the income here, then make it taxable. Compute the income here, then make it taxable. It means, let's say from this business, she is receiving a salary of 5 lakh rupees. She is receiving a salary of 5 lakh rupees. So should I make it taxable 5 lakh rupees total here? No. See, first of all, compute the salary income. So we understand if she is getting a salary of 5 lakh rupees in a year, then there is a standard deduction also. Please compute it. So at least standard deduction you should give. So if it is optional regime, 50,000. If it is default regime, 75,000. So let's say I will subtract 75,000 in case of default regime. So it will become 4,25,000. So this 425 would be clubbed in the hands of A. Got it, guys? So first of all, compute the income and then make it taxable in the hands of A. And under which head it would be taxable? It would be taxable in the same head to which it belongs. So it would be Mr. A's salary income. It would be Mr. A's salaries income. Got it? So whenever the assessee is, or the individual has a substantial interest in any business and his or her spouse is getting a remuneration without any skill, qualification, experience, then that income would be clubbed. But if they have any particular qualification, experience, or skill, then it will not be clubbed. Next, if both husband, this is not that important, but yes, if both husband and wife have substantial interest, let's say A has also substantial interest, Mrs. A has also substantial interest, and they both are receiving remuneration, they both are receiving remuneration without any qualification, experience, or skill, then in that case, it this remuneration will be clubbed in that particular hand whose other income is higher. So let's say Mr. A other income is 10 lakh, Mrs. B other income is 12 lakh, other than this remuneration. So all the remuneration will be clubbed in the hands of Mrs. A. Got it? So it will be clubbed in the hands of that individual whose other income is more. This is not that important. Asset transfer to spouse. So whenever we transfer any asset to spouse without consideration or inadequate consideration. So let's say this is Mr. A and Mr. A transfer any asset if they transfer to Mrs. A to his spouse without consideration or inadequate consideration. See, if there is adequate consideration, then there is no problem, no clubbing. But if it is without consideration or inadequate consideration, that whatever the income which she is getting, whatever the income she is earning on that asset, that income will be clubbed. That income will be clubbed even if the asset form or shape is changed. Let's say we have transferred shares, dividend will be clubbed, the income will be clubbed. Let's say she has sold the shares, and she has purchased debentures. So even if the form of asset or the nature or shape of asset is changed, doesn't matter. So first of all, we have transferred shares. She has sold the shares. She has purchased debentures. Then the interest on debenture will also be clubbed. Understood? So change of form or shape doesn't matter. Second thing is that if income, let's say the asset is transferred of rupees 10 lakh, where the income is generated of 2 lakh rupees. So this 2 lakh will be clubbed. But any income which is arising on this clubbed income, the clubbed income is 2 lakh. So let's say Mrs. A keeps this 2 lakh with her. Doesn't matter, 2 lakh will be clubbed in the hands of Mr. A. 2 lakh will be clubbed in the hands of Mr. A. She keeps this amount with herself, and then she invested it somewhere and she earned 25,000 rupees on this income. This is called income on clubbed income. This is income on clubbed income. 2 lakh was clubbed, right? So this amount will not be clubbed. Income on clubbed income will not be clubbed. Got it? But it is also important that whenever you apply clubbing in the case of spouse or son's wife also, at the time of transfer of asset, the relationship should be there. At the time of earning of the income, the relationship should be there. So when the asset is transferred, she was his or her spouse, or when the income is getting generated, then also the spouse relation was there or son's wife relation was there. Correct? If Mr. A transfer house property, building to Mrs. A, clubbing provision will not apply. In that case, you understand section 27, deemed ownership concept will apply, and Mr. A has to pay tax directly under house property. So any asset is transferred other than property. So if property is transferred, then section 27 will apply, deemed ownership. But if any other asset is transferred other than property, then clubbing provisions will apply. Got it? If the capital is invested in a spouse business, if we invest capital in a spouse business, please remember that profit which is arising from that business. So let's say there is Mrs. A, she's having a business, and in previous year 23-24, her opening capital, we have to see only the opening capital. Her opening capital of the business is 20 lakh. Or opening capital is 20 lakh, and during this year, let's say on 2nd April 23, this year, Mr. A invested 10 lakh rupees in her business. So now her capital has increased from 20 to 30 lakh. Initially it was 20 lakh, 10 lakh was invested by the spouse, Mr. A. rupees 10 lakh. So now the capital of the business will become 30 lakh. And in this year, she has earned a profit of, for example, 6 lakh. So this 6 lakh profit which is earned on this capital, this would be split between Mr. A and Mrs. A also. So I want to tell you that out of this 6 lakh, something will be clubbed in the hands of Mr. A. How much it would be clubbed? Out of 6 lakh, how much it will be clubbed? So you have to see that how much Mr. A has invested, but that too on the first day of the previous year. First day means 1st April. Do you remember this? Are you able to recall this? First day of the previous year. So you have to see in the numerator, said what is the amount invested by A as on 1st April 23, 1st April 23, divided by capital of the business as on 1/4/23 into the profit earned. So 6 lakh is the profit. Investment as on 1/4/23 is zero. Why? Because he invested on 2nd April, the second day, although it is second day, but it is not 1st April. So in this case, there would be no clubbing. Why? The numerator will say zero. Because on 1st April 23, we have not actually invested anything. So it is zero divided by capital as on 1/4/23. It was 20 lakh opening capital into profit 6 lakh. So it would be zero. So in this case, in this year, nothing will be clubbed in the hands of Mr. A. And that 6 lakh would be taxable in the hands of Mrs. A only. But let's say now in the next year, previous year 24-25, previous year 24-25. Now, let's say this year, this business has earned 8 lakh rupees. Now, how much amount will be clubbed? Now there would be clubbing. Why? Because on 1st April 24, some amount was already invested by Mr. A because he invested last year. So how much he invested? 10 lakh rupees. So 10 lakh rupees he invested as on 1/4/2024. He invested 10 lakh rupees before only he has invested. Total capital as on 1/4/24. So tell me how much is the capital on 1/4/24? Last year the capital was 20. 10 lakh was additional capital introduced 30, and profit earned is also is the part of capital, right? So at the end of the year, whatever the profit we have earned, that will go in capital. So 20 plus 30, sorry, 20 plus 10, 30 plus 6, 36. So 10 upon 36. Are you able to understand how I got this 36? Into the profit for the year is 8 lakh. So this amount will be clubbed in the hands of Mr. A. Everybody understood this? Now, good. Income of a minor child. This is also important. Minor child income is generally clubbed in the hands of parent. Which parent? Either father or mother, not in grandparents. No, either father or mother whose other income is higher. So if father other income is higher, it will be clubbed in the hands of father. If mother income is higher, it will be clubbed in the hands of mother. But in case of single parent, then it will be clubbed in the hands of that parent who is maintaining the child. But in these three cases, minor child income will not be clubbed. If the minor child income is coming from his manual labor, manual or physical labor, or it is because of his knowledge, talent, or experience, or if the minor child is disabled, in these three cases, I'm again repeating: income from manual labor, income from specialized knowledge, talent, or experience, income of a minor child who is disabled. In these three cases, minor child income is not clubbed. Otherwise, all the income of minor child will be clubbed in the hands of parent, either father or mother. Second thing is that if you are following optional regime, and if minor child income is clubbed in the hands of either father or mother, then for every minor child, whatever the income is getting clubbed, there is an exemption of 1500 per child. But this exemption is not available in default regime. So 1500 is available only in case of optional regime. It is not, it will not apply in case of default regime. Got it? Single parent we have done. HUF, no, not required. Not required to do HUF. Okay. Set off and carry forward of losses. This is again an easy chapter. So first of all, we understand what is intra-head set off. Intra-head set off, that we can set off the losses from the same head. So generally in, first of all, if I tell you about, let us do one by one. So we have heads like salary. In salary, we don't have any losses, so there is no problem in salary. In case of house property, please understand house property, this is a little important. In case of house property, see, if you are following optional regime versus default regime, in case of house property. First of all, same head setup, that is called intra-head setup. House property 1, house property 1 can be set up from house property 2, no problem, no limit for this. HP1 can be set up from HP2, that is intra-head setup. The same is applicable in default regime, no problem at all. Intra-head setup is allowed. Intra-head setup is allowed. Now, inter-head setup. So if house property has a loss, if house property has a loss, can we set it from any other head, from salary, PGBP, capital gain, or IFOS? The answer is yes. Interhead setup under optional regime is allowed. Interhead setup under optional regime is allowed. It can be set off from salary, PGB, capital gain, IFOS, but maximum 2 lakh. But maximum 2 lakh rupees. But in case of default regime, interhead setup is not allowed. Interhead setup is not allowed. You cannot set it off from any other head. So house property loss cannot be set off from any other head. Correct? Now an important point, guys. Now an important point. I'm giving you a point which I have not discussed. In fact, a contradiction point I have discussed in my classes. So actually, there is a little bit issue with the study material. So, but as of now, we have to go with the study material. House property losses, I've told you in default regime, I've told you in default regime, house property losses, please understand this. House property losses cannot be set off from other head. That is okay. Now, if it cannot be set off, can it be carried forward? Can it be carried forward? Study material says no. Study material says, ICI study material says no, it cannot be carried forward. Although the Bear Act has a different opinion about it, but now this is not the time to discuss right now. But for tomorrow examination, if house property loss is there under default regime, carry forward, please deny, carry forward, it is not allowed. As per right now, you can go with the study material. Although Bear Act has little bit different point of view, so right now I'm not discussing it. But please, again, I'm repeating, I want your confirmation, everyone. Have you understood it or not? So house property losses under default regime cannot be carried forward. Tell me, have you understood this or not? Yes or no? I need a confirmation here. Although I have to discuss this on this point, but right now this is not the correct time to discuss. Under optional regime, you can carry forward. Under optional regime, house property losses can be carried forward for 8 years. But under default regime, please, after this class also, because there are not many students who are present here right now. So after this, somebody please post it on the group also, that under default regime, house property losses will not be carried forward. Will not be carried forward, although it has different opinion for self-occupied and for other things. But please, for now, for your examination purpose, for tomorrow, house property losses will not be carried forward. Got it? Now, coming back to PG, now coming to PGBP, if we have a loss under PGBP, now it depends what kind of losses we have. So PGBP, if we have a speculative business loss, speculative business loss, speculative business loss can be set off from only from speculative business income, not from any other business income. So speculative from speculative only. Specified businesses, 14 businesses under optional regime. So specified only from specified businesses, but other PGBP, which is not speculative, which is not specified, other normal PGBP can be set off from any other PGBP, from any PGBP, either normal, either speculative, either specified, no issue. Understood? I'm again repeating, speculative business loss from only speculative, not from anything else, not from any other PGBP. One speculative from other speculative only. Specified from any other specified only. Out of those 14, you can set off from any other 14 only. Normal PGBP, normal business can be set off from any PGBP, even from speculative, even from specified. Vice versa is not correct, but yes, normal PGBP can be set off. This is called intra-head set off. Inter-head set off, if you ask me, inter-head set off, obviously speculative and specified will not be set off from other heads because they have restriction in their own head. They have restriction in their own head. Obviously, these two will not be set off from any other head, but PGBP can be set off from other head, not from salary. And of course, from casual income, we cannot set off anything. So PGBP losses cannot be set off from salary. House property losses can be set off from salary. Yes, under optional regime from salary, PGBP house property can be set off, but PGBP losses cannot be set off from salary and of course from casual income. Casual income, nothing can be set off. So this was about PGBP. Same thing in default and optional. There is no issue. Only house property is a different point in optional and default regime. But for all other losses, there is no particular issue. Then capital gain, you understand capital gain income cannot be set off from other head. Interhead set off is not allowed in capital gain. Same head can be allowed, but you understand that long term and short term. Long term has more ego. I've told you in classes, long term has more ego. Long term loss can be set off only from long term profits, whereas short term losses can be set off from short term or long term, no issues. But it cannot be set off from other heads. Interhead is not allowed. Interhead is not allowed. So long term only from long term. Short term can be from short or long also. Again, they can be carried forward for 8 years. They can be carried forward for 8 years, and the return should be filed on time. If you want to carry it forward, ROI must be submitted on time. Same thing with PGBP. Any PGBP can be carried forward generally for 8 years. Generally for 8 years. But if it is speculative business, you understand it can be carried forward for 4 years only. Specified business can be set off for unlimited years. It can be carried forward for unlimited years. But one thing is common, that the ROI must be filed on time. House property losses can be carried forward under optional regime for 8 years. Return can be filed late also. In house property, return can be filed late. But in PGBP, in capital gain, return should be filed on time. But in house property losses can be carried forward under optional regime. Please remember, house property losses cannot be carried forward under default for examination purpose. Rajalakshmi, if LTCG, STT paid and STC triple one if given, then see LTCG, STT paid is long term only, na? If I am understanding your question correctly, you are asking me if LTC, STD is paid. STD is paid, I think that you are talking about 112A. Okay. And STCG is triple one A. Okay. If you are asking me that can we set off 112A from triple one A, the answer is no. Whether triple one A can be set off from 112A, the answer is yes. So please don't get confused with triple one A or 112A. Don't get confused with 112A or triple one A. Please take it as short term and long term only. See, 112A is long term. It can be set off from any long term. It can be set off from any long term. Got it? Please don't take it as triple one A. Take it as short term only. And short term can be set off from short term also, long term also. Am I able to answer you correctly? Was that your question, Rajalakshmi? Okay. So please don't get confused with 112A, 111A, because what is the nature of 112A? It is long term only. Na? So any long term. So here, when I'm talking about long term, it could be 112A also, it can be 112 also. So I'm not getting confused with these two. They are long term at the end of the day. Triple one A, it is short term only. So short term can be set off from short term, it can be set off from long term. Correct. Joseph, if STT is not paid, it means that it is not sold on stock exchange. If STT is not paid, it is not sold on stock exchange. So first of all, it is not 112A or triple one A. So it is, if it is long term, it is normal long term. If STT is not paid, then it will become normal long term 112. Got it, Joseph? So 112A is only when STT is paid. Second thing, if it is short term, STT is paid, then it will become triple one A. If STT is paid, then it will, what is STT actually? It is securities transaction tax. That means you are selling your shares on stock exchange. So that is STT. So if STT is paid, it means it is triple one. If it is short term, if STT is not paid, it will become normal short term. Got it? Okay. This is what I have to do. Okay. Generally, guys, in IFOS, you don't get losses in IFOS. The only issue is with the owning and maintaining racehorses. So if you are in, if the assessee is in the business of owning and maintaining racehorses, is it a casual income? No, 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 it's not a casual income. See, whenever you go to a horse race and you actually bet on any horse, that is a casual income. That is a casual income. But in case this assessee is into a business of owning and maintaining racehorses, that the entire race course is his business. So in that case, it is not a casual income, and it is covered under IFOS. Although it is a kind of PGBP, it should be PGBP, but specifically the law has covered under IFOS, but it is not casual, right? So if the assessee is into a business of owning and maintaining racehorses, and if there is any loss, that loss can be set off only from such kind of business only. Such kind of business only, it means owning and maintaining racehorses only. And if it cannot be set off this year, it will be carried forward for 4 years only. So it is a kind of speculative. It would be for 4 years only. Return of income must be filed on time. Got it? Okay. This was about set off. Also please remember, guys, casual losses are not allowed. So let's say if there is a casual income, for example, there is a casual income of 5 lakh, and let's say under casual there is a loss. There is a casual income number one, 5 lakh, casual income number two, and it is 2 lakh rupees loss. Casual income number two, 2 lakh rupees loss. Can a casual income number two can be set off from casual income number one? The answer is no. Casual income deduction or losses are not allowed. So you cannot set off your casual income losses. So 5 lakh, you have to pay 30%. 2 lakh loss, what will happen to this 2 lakh loss? It is a dead loss. So there is no such loss like casual income. Correct? So if examiner would try to confuse you, never get confused. Second thing is that if there is also an income from exempt source. So let's say if there is any agriculture income from India, it is exempt. So if somebody earns 10 lakh rupees as an agriculture income in India, it is exempt income. You don't pay taxes. The same way, if the assessee has a negative agriculture income, losses, so can you set it off from somewhere? The answer is no. Exempt means exempt. Positive is exempt, negative is also exempt. So if positive we don't consider, then negative also we will not consider. So if there is any loss under exempt source, please do not set it off. This is again, examiner keeps on testing students on this. So if there is any exempt income, that is not an income, it is not a taxable income. So you don't have to do anything, you have to ignore. The same way, if it is negative, you cannot set it off, you have to ignore, that is a dead loss. So please give a note that this loss is coming from exempt source, it cannot be set off. Got it? Okay. Give me a moment. Okay. Deductions under chapter 6A, 80C to 80U. So mostly you understand that this particular chapter is mostly for optional regime. In default regime, we have a very less deduction. In default regime, we have only 80. We have 80 CCD2. We have 80 CCH2 Agniveer scheme. CCD2 is new pension scheme, and we have 80 double J double A new workmen. So only these three deductions are allowed under default regime. Otherwise, all other deductions, these also are in optional regime. So this chapter is more for optional regime, but only these three are allowed in default regime also. 80C. So 80C deduction, you understand, maximum deduction is 1,50,000 rupees. 150 is a deduction. Individual ratio is the maximum amount, and the assessee can invest in these type of uh, schemes, or in these types of investment. The assessee can invest, and he or she will get 1,50,000 maximum. So if the assessee is paying life insurance premium, so I'll be explaining some of the points which are quite important, which are quite frequent. So life insurance premium is an important point. So if the individual HUF is paying for any member, HUF is not that important, but individual, if individual is paying for self, spouse, or children, children can be dependent, non-dependent, does not matter. Guys, in 80C, if the life insurance premium is paid for parents 80C is not allowed. Health insurance is allowed in 80D for parents, but here parents are not covered in 80C. So individual, self, spouse, or children, now you have to see that how much deduction is allowed under 80C in case of life insurance premium. So the same thing you have to remember, if this the policy date is before 1st April 2012, then 20%. For next 1 year, it is 10%. And after that, it is 10% generally, but 15% in case of disable. So if anybody is paying premium more than that, so first of all, you have to ascertain whether 20% is applicable, 10% is applicable, or 15% is applicable. Generally, I'm telling you, if nothing is mentioned, please apply 10% only. So if the assessee is paying a premium which is in excess of 10% of the sum assured, then that excess will not be allowed. Only up till 10% is allowed, right? This is an internal limit. What is the external limit? External limit is 150. See, you cannot go more than 150, but in LIC, there is some internal limit also. Deferred annuity plan is not important. Employee contribution to SPF or RPF. See, employer contribution to RPF is taxable under salary, and there is a deduction of 12% of retirement benefit salary, right? Employer contribution deduction is available in the chapter of salary only. And what will happen to the employee contribution? Whatever the employee is contributing, it is a kind of investment. He will get this deduction under 80C, but only under optional regime. PPF, Public Provident Fund, is also an eligible investment under 80C. Sukanya scheme, not that important, but yes, Sukanya scheme is also applicable. National Savings Certificate, NSC, is important. Then tuition fees, maximum for 2 children, and that too in India. That too in India. Here in 80C, this education should be in India. If it is outside India, 80C is not applicable. But yes, for education loan, when we will do 80E, that loan can be taken for education in India also and outside India also. In 80E, it is no problem. But in 80C, this education should be in India, maximum for 2 children. And it is tuition fees, that is school fees or college fees, and that too for a full-time education. Principal repayment of the housing loan, only for the housing loan, and that loan which you have taken it for purchase or for construction, that's it. If you have taken a loan for repairs, renovation, or reconstruction, that is not allowed. Any other loan, that is not allowed. So only residential house property loan is allowed. That is only for purchase and construction. Principal repayment, fixed deposit 5 years, post office deposit scheme, not that important. That's it. So please remember, in 80C, maximum deduction is 1,50,000 rupees. In 80 triple C, this is contribution to certain pension funds, certain pension funds. So there are so many pension schemes. I'm not talking about new pension scheme. No, I'm talking about normal pension funds of any insurance company or any mutual fund company. So 80 triple C is allowed over there. Maximum it is 1,50,000. But you also know that the total deduction of 80C, 80 triple C, and 80 CCD1, again, I am repeating, 80C, 80 triple C, 80 CCD1, all three combined together cannot go more than 150. They all three combined together cannot go more than 150. 80 CCD, this is an important deduction for new pension scheme. For new pension scheme, it is divided into three parts: 80 CCD1, 80 CCD1B, 80 CCD2. Guys, this 80 CCD2, this one, 80 CCD2, this one is only and only allowed. This is under both the regimes. So it is in optional regime, of course, but this is in default regime. But these two are only under optional. Got it? In optional, this is also allowed, this is also allowed. Of course, this is also allowed, but in default, only this is allowed. So CCD1 and CCD1B is the assessee contribution. These two are the assessee's contribution. These two are the assessee's contribution. CCD2, this is the employer contribution. This is the employer contribution. How much is allowed? CCD2, how much is allowed? First of all, in case of optional regime, 10% of salary is allowed. So whatever is the employer contribution, whatever is the employer is contributing, just see that, or 10% of salary. Here salary includes basic salary. Here salary includes basic salary plus DA forming part. Basic salary plus DA forming part. So here 10% of the salary. But if in case of default regime, you have to take 14% of the salary. So in case of optional, it is 10%. In case of default, it is 14%. But if the assessee is a government employee, then it is 14%, whether it is optional, whether it is default, it is 14%. Guys, you will not get for the government employees. In examination, generally, they don't ask you for the government employees. So 14%, this generally you will not get, but at the back of the mind, please remember, if the assessee is a government employee, then employer contribution is allowed 14% under any of the regime. But if the assessee is a non-government employee, generally they ask you about non-government employee, it is 14% or 10% of salary, right? And what about then these two contribution is assessee's contribution. So first of all, you have to give CCD 1B. How much is CCD 1B? Whatever is the assessee's contribution, or 50,000 rupees. So there is a limit of 50,000 rupees. Whatever is the assessee's contribution. So let's say assessee is contributing, for example, assessee is contributing 2 lakh rupees. 2 lakh rupees the assessee is contributing. So first of all, try to give 80 CCD 1B deduction. So whatever is the assessee is contributing 2 lakh or rupees 50,000, whichever is lower, 50,000 you will get it over here. Correct? Now, in CCD 1, how much you will get? First of all, how much is assessee contributing 2 lakh? 50,000 you have claimed over here. So here you will remain with 150. 150 over here. So remaining contribution of the assessee 150. Second limit is 150. See, coincidentally, I have taken, let me change this. Let's say the assessee's contribution is 2,10,000. Assessee's contribution is 2,10,000. First of all, try to give CCD 1B. Try to give CCD. See, in default regime, you will not get this too. It is only under optional regime. So try to give before CCD 1. I would suggest you apply CCD 1B. So let's say assessee's contribution is 2,10,000. So here you will get 2,10,000 or rupees 50,000, whichever is lower. So it is 50,000. So 50,000 you will get it over here. Now out of 210, 50,000 we are enjoying. So whatever is left, it is 160 is left. So one deduction over here is 160. Second deduction, we all know that second deduction is 1,50,000. It is combined deduction of 80C and 80CCC and CCD1. So what we will do, 1,50,000 minus 80C minus 80CCC. So we will do this amount also. Why? Because if whatever we have exhausted in 80C or 80CCC, then we will not get that amount. So let's say if the assessee has already claimed, for example, 90,000 in 80C, he has already claimed 15,000 in 80C, then obviously the total limit is 150. So 150 minus 90 minus 15. So whatever is the amount which is left, then only you will get this deduction. And the last deduction is 10% of the salary. 10% of the salary, basic salary plus DA forming part. Got it? So 150 minus section 80CCC. Here 8CCE is written, but actually it is 80CCC and 80C. Second thing is 10% of the salary, basic salary plus DA forming part. This is not that important, but if the assessee is a non-salaried assessee, see, for non-salaried assessee, CCD2 is not applicable. Why? Because CCD2 is employer contribution. And in case the assessee is a non-salaried, then he will not be enjoying 80 CCD2. Why? Because there is no employer. So for non-salaried assessee, we will not take 10% of salary. We will take 20% of the GTI. We will take just 20% of the GTI. Not that important. In case CCD will come, it will generally be the question of salaried assessee. Okay, that is not that important. CCH, Agniveer Corpus Fund. I don't think, although it's very easy. CCH. CCH is CCH1, CCH2. Guys, in optional regime, we will get both of them. But in default regime, we will get only this. In optional, we can get both of them. In default, we will get only this. Got it? So what is the deduction available over here? So there is no limit as such. CCH1 is whatever the employee is contributing to Agniveer Fund. CCH2, whatever the employer is contributing to the Agniveer Fund. This is employee contribution. This is employer contribution. Got it? Only CCH2 is in default regime. So there is no such limit as such in CCH. 80D, very, very important deduction, but only under optional regime. You will not get in default regime. Individual and HUF they can get. So in 80D, we'll segregate into two parts. First category is self, spouse, and children. Children should be dependent children here. See, in 80C for life insurance premium, children can be dependent, non-dependent. Parents were not covered in 80C, but here parents are covered. So here, first category is self, spouse, and dependent children. Second is parents, whether they are dependent, non-dependent. Here parents are covered. Here parents are covered whether they are dependent or non-dependent. So 25,000 in this category, 25,000 in this category. So total deduction which we can get is maximum 50,000 rupees. In case the parents are senior citizen, resident senior citizen, so this 25,000 will be increased to 50,000 rupees. So this 25,000 will be increased to 50,000 rupees. And in case the assessee himself or herself is a senior citizen or the spouse is a senior citizen, this limit will also be increased to 50,000. Generally 25, 25, but it could be 25, 50 also. It could be 50, 50 also. Got it? And please remember, this health insurance premium should not be paid in cash. If it is paid in cash, it will not be allowed. However, preventive health checkup can be paid in cash. Preventive health checkup, but maximum limit of the preventive health checkup is 5,000 rupees, and it is a total limit for both the categories. 5,000 is a total limit. So if the preventive health checkup we have already taken, let's say 3,000 over here, maximum here we can take 2,000 rupees only, and it is within this limit. It is not an extra limit. It is within that limit. I believe that you are able to recall this provision also. And please remember, if the assessee is a senior citizen, if the assessee is a senior citizen and he's not having his health insurance policy, even his medical treatment expenses are allowed. Even his medical treatment expenses are allowed as if he is paying health insurance premium. So even his medical treatment expenses are allowed. Second thing is that if the premium is paid for more than 1 year, if the premium is paid for more than 1 year, then how much you should take? So I've already explained you in practice sessions, also in class, also in normal class also, I've explained you that whenever this health insurance premium is paid, so whatever is the lump sum premium, please divide it by the number of relevant previous year. Divided by number of relevant previous year. Please don't make a mistake over here. So in case the assessees, the question is saying that this policy is for 3 years. So should we divide it by 3 years? So you have to check it. You have to check that how many previous year are getting affected. So let's say if the policy is starting from the date, for example, let's say the policy is for 3 years. Let's say the policy is for 3 years. And it is starting from 1st of, let's say, July 24. So it will end on somewhere on 30th of June 27. This is 3 years. But tell me how many previous year are getting affected. So this is the year when it is started, previous year 24, 25. This is the year when it will be completed. This is previous year 27, 28, right? This date is belongs to previous year 27, 28. And also now the previous year in between is previous year 25, 26, previous year 26, 27, and 27, 28. So actually the number of relevant previous year is 4. Although the tenure of the policy is 3 years, but actually 4 years are getting affected. So the denominator should be number of relevant previous year, that is 4. So whatever is the lump sum premium, over here, please divide it by 4. So this is the amount of deduction which you can avail. Maximum, please also see that it should be maximum 25,000, 50,000 as the case may be. Why I'm saying this 25,000, 50,000? Because of these two limits. Got it? Harini, correct. 4. 80 double D medical treatment of disabled DD. DD is disabled dependent. So there is a flat deduction for 75,000 or 125,000. There's a flat deduction 75 or 125. Even 80U is a very similar section. If the assessee himself or herself is physically disabled, then 75,000 or 125 is the flat deduction, but that is under optional regime only. 80 DDB, medical treatment of the prescribed disease like cancer, tuberculosis, etc. So if there is a medical treatment, the deduction would be actual amount of medical treatment. It can be for individual also. It could be for his family also. Family here means spouse, children, whether dependent, non-dependent, parents, brother and sister, if they are dependent. So here, the amount of medical treatment or 40,000 rupees, whichever is lower. But in case the treatment is for a senior citizen, then it would not be 40,000, it is 1 lakh. Please um, understand, please learn this particular amount, 40,000 or 1 lakh. Although 80 DDB, I can't say, look, it can come in your examination, but not very, very important deduction. So 40,000 or 1 lakh, whichever is, it depends. So if the assessee or the person who is getting treatment is a senior citizen, then 1 lakh, otherwise 40,000. In case, so whichever is lower. So let's say the actual expenses incurred is 60,000 rupees or 40,000, whichever is lower. Let's say the person for whom the treatment is done is not a senior citizen. 60 or 40, whichever is lower, it comes to 40,000. So this is the deduction which you will get in 80 TDB. But in case if something is recovered from the insurance company, so first of all, 60 or 40, 60 means let's say actual expense is 60, for example, 60 or 40, whichever is lower, 60 minus any recovery from the insurance company. So let's say 15,000 is recovered from the insurance company, then 25 deduction would be applicable over here. So anything that is recovered from the insurance company, you have to deduct from this particular amount. This was 80 DDB. 80E. 80 is for loan for higher education. This is an important deduction, but very, very easy. So this loan can be taken for the assessee himself, for spouse, for children, or for any person for whom he is legally liable for studies. So he can take an education loan. This higher education can be in India. It can be outside India. There is no problem. So whatever is the interest which is paid during the year, that is allowed. But maximum it is allowed for 8 years. That is not that important, because whenever you start paying your EMI, from that you can get the deduction, but for maximum 8 years only you can get this deduction. That is not important, that will not come. But you should know that for higher education, interest is allowed. This loan can be taken from financial institution, government, or approved charitable institution. Not that important. 80 EE, EEA and EEB are not that relevant sections, because these actually are not that relevant. Why? Because they are very, very restrictive sections. So if the loan is sanctioned between these dates, then only this will be allowed. So it will not come now. It will not come now. These are quite outdated sections now. So generally, if you pick up the paper of last 2, 3, 4 attempts, you will not get these. You will not see these deductions. So you can safely leave them. 80 EEB, okay, we can do it also, although it will not come, but at least EEB is little bit, I can say, out of these three, this can be a little bit relevant, relevant. So this 80 EEB is only for interest on loan for e-vehicle. So if you have purchased an e-vehicle and you are paying interest, then you can get 80 EEB. But see, if it is a business vehicle, then interest is allowed under section 36 only, that is as a business expense. So if you are getting a deduction in the section, any other section, then 80 EEB will not be applicable. Generally in classes also I have told you that it is mostly for personal vehicle, because if it is a business vehicle, you can claim the deduction under business expense only, interest on loan. Because see, whenever you are having a business and you are purchasing any vehicle for your business, so that is for your business purpose. You can straight away go and take the deduction under section 36. That is a business expense. So why you want to come in 80 EEB? Because 80 EEB will say that I will not give you a deduction here because you are already claiming a deduction there. Correct. So this is mostly for personal vehicle, mostly for personal vehicle. But now the thing is that the loan must be sanctioned between 1/4/2019 till 31st March 23. 31st March 23 is last year, guys. So that is the reason. That is the reason I'm telling you. In fact, last to last year. So that is the reason I'm telling you that this is quite irrelevant section now. But yes, the maximum exemption which you can claim is 1,50,000 rupees. Not that important. 80G donation, evergreen section. Examiner keep on asking about 80G. So you understand, you will divide this into 4 categories. So it depends on which category does this donation falls. So if it is first category, then 100% of the deduction you will allow. If it is second category, then only 50% deduction is allowed. In second category, there is only one point: Prime Minister Drought Relief Fund. So if you are paying to Prime Minister Drought Relief Fund, then 50% of the donation would be allowed as deduction only under optional regime. But if you are paying here, so these are mainly government funds. These are mainly government funds. What are these? National Defense Fund. So if you are paying to National Defense Fund, so right now we are at the verge of war with Pakistan. So if you want to donate to National Defense Fund, please go and donate it. You will get 100% deduction, right? So National Defense Fund, if you will donate, so now people will start donating in National Defense Fund in case there should not be war, but still in case there is a war, 1%, 2%, then people would be donating in National Defense Fund, 100% reduction they will get. Got it? Prime Minister National Relief Fund, National Children Fund, and I've told you in the classes also that most of the time you will see national word written over there. So Prime Minister National Relief Fund, National Children Fund, National Foundation for Communal Harmony, approved universities, Zilla Saksharta Samiti, not that important, National Sports Fund, National Culture Fund, Swachh Bharat Kosh, Clean Ganga Fund, National Fund for Control for Drug Abuse, and PM Cares Fund. So here, if you will donate, you will get 100% deduction. No need to read it again. This is the thing which you should remember. National Defense Fund, Prime Minister National Relief Fund, Children Fund, Culture Fund, Sports Fund, PM Cares Fund. That's it. Next is, here you will get straight away 100%. Here you will get straight away 50%. But in case the assessee is donating in this third or fourth, it is subject to a specified limit. How much is the limit? Here, if the assessee is donating for promotion of family planning, it is giving a donation. See, family planning expenses are not allowed. Family planning expenses are not allowed for individual assessee. It is allowed only for the company assessee. Please don't make any mistake over here. See, if in your exam tomorrow, there's a P&L account, so let's say there is a P&L account, guys, and in your P&L account, you find that there is a family planning expenses, whether revenue, whether it is capital, and it is a individual P&L account, and mostly you will get individual P&L account. So if it is revenue or capital, please don't allow it. It is not allowed. So now some students will ask me, sir, now can we give a deduction in 80G? No, 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 no. The 80G is that if you are paying anything to any association or institution, here you are just doing family planning expenses. Here you will not get any deduction. That deduction is when you are contributing anything, when you are giving as a donation to any approved institution, then you will be there under 80G here. So if you are the assessee is contributing for promotion of family planning to any approved institution who are actually engaged in family planning projects, then only deduction would be applicable. Also for Indian Olympic Association, Indian Olympic Association is mostly for company assessee. For company assessee, you can claim, but you will not get this. Maximum you can get this, that the assessee has contributed for the promotion of family planning to an approved institution, then 80G is allowed 100%. 100% of the amount donated or 100% of the qualifying limit, whichever is lower. What is the qualifying limit? I'll be telling you. Second thing, if the assessee is donating to any other approved charitable institution or any other approved NGO or for renovation of religious places like temple, mosque, church, or gurudwara, so if the assessee is paying for that purpose, then 50% of the amount contributed or 15% of the remaining qualifying limit. 50% of the amount contributed, 50% of the remaining qualifying limit. So what is the qualifying limit? Qualifying limit is 10% of adjusted GTI. 10% of adjusted GTI. So what is adjusted GTI? GTI. So I have already told you that 80G is something which you should actually take this deduction at last. First of all, take all the deductions, then you should compute your 80G, especially if in your examination something is there here or here. See, if you have in your examination, there is only donation which are going in first box or second box, then there is no problem for qualifying limit. Qualifying limit thing should only be considered over here. qualifying limit should only be considered over here, right? So qualifying limit is 10% of adjusted GTI. What is adjusted GTI? GTI minus all deductions under chapter 6A except 80G minus short-term capital gain minus long-term capital gain. That is 111A, 112A, etc. Do not exclude casual income. No deduction shall be allowed if the amount is paid in cash more than 2000 rupees. So if you are paying more than 2000 rupees, not that important. But if you are paying in cash more than 2000 rupees, then no deduction is allowed under 80G. 80 double G, not so important. What is 80 double G? It is a donation for rent paid. If you are paying a rent for your house, and this deduction is only available to that assessee who's not getting HRA. So who's not getting HRA, then only that person can claim deduction under 80 double G. So how much is the deduction he will get? Just remember this, least of the following: actual rent paid minus 10% of adjusted GTI, 25% of adjusted GTI, or 5,000 rupees per month. This is the limit. Actual rent paid minus 10% of adjusted GTI, 25, not a very important deduction, 80 double G. Generally, I tell students you can leave this deduction. Very, very rarely they can ask. Very rarely. So 80 double G is, again, I'm repeating, actual rent paid minus 10% of adjusted GTI, 25% of adjusted GTI, or 5,000 rupees per month is the fixed limit. What is adjusted GTI? Same thing. GTI minus all deduction under chapter 6A except 80 double G minus short-term capital gain minus long-term capital gain. Got it? So here short-term capital gain, by short-term capital gain, actually I mean 11111A, only 111A. There also I mean only 111A. 80 GGA, not very important. 80 GGA is if you are donating for scientific research and you cannot claim deduction under section 35. Why you can't claim deduction under section 35? Because you are not a business assessee. See, if any assessee is having a PGBP income and he is giving an outside scientific research, then he will go in section 35. But people who does not have a PGBP, who do not have a PGBP, still they are giving donation to scientific research or for rural development, 100% deduction they can claim over here. Why? Because they cannot claim deduction under PGBP because they don't have PGBP. So let's say there is a salaried assessee and who is giving the donation to IIT or National Laboratory, then he can claim a deduction here because for that person, section 35 is not available because that person does not have PGBP. Section GGB and GGC, in fact, GGB is for company assessee, GGC is for other assessee. So for us, mostly GGC is more important. So if you are donating to any approved political party, 100% of the amount contributed is allowed as deduction. So donation to political party is allowed. It is not allowed as a business expense. So any expenses which you have paid as a business expense, please don't allow it while computing your PGBP, add it back. However, the amount paid to a political party is allowed under GGC. Please also remember, if you have paid a contribution, see, GGC is a contribution to approved political party. If it is unapproved, don't allow it. Only if it is approved political party, or if even political party is written, nothing is written about approved, unapproved, then we will assume it is an approved. So contribution to political party is allowed. If you are given an advertisement in political party, that is not allowed in 80 GGC. Advertisement in political party is not allowed. See, again, I'm repeating, little bit important. In your P&L account, if you will find advertisement in political party or contribution in political party, guys, simply disallow it while computing your PGBP. Nothing is allowed. Neither the advertisement in political party, neither the contribution to political party. While computing PGBP, I'm saying, while computing PGBP, simply disallow it. Simply disallow. Got it? Now, if you are following optional regime, let's say advertisement in political party is 1 lakh, contribution to political party is 2 lakh. First of all, while computing PGBP, disallow this 1 lakh, disallow this 2 lakh. Got it? Now, next point is, if you are following optional regime, then 80 GGC, how much would be allowed? This 2 lakh. Contribution would be allowed. advertisement will not be allowed. Understood? Advertisement will not be. So I can say that advertisement is neither allowed as a business expense nor as a contribution in 80GGC. 80JJAA. 80JJAA is for new employment. It's for new employment. It is only available to that assessee who is eligible to get his books of accounts audit. Eligible assessee is only that assessee who is required to get his books of accounts audit, and he's giving employment to people, and he's giving employment in such a manner that he's actually increasing his employment compared to last year. This year he has actually recruited more people. So let's say the last year number of employees he is having 120, and this year it is 130 at the end of the year. So the 10 extra employees, that is called additional employees. So to these people who are actually this 10 extra employees, whatever the salary which we are paying, salary is a expenses PGBP, but additionally we will get 80JJAA also. So I'm again repeating this deduction is, first of all, it is available in both the regimes, in optional also and default also. Those people who are getting their tax audit done, only for those people it is allowed. Whatever is the salary which you are paying to these eligible employees, whatever the salary which you are paying to the eligible employees, 30% of that salary is allowed. 30% of such salary or wages is allowed, and that too in 3 years. 3 years is not important for examination. If 80JJAA will come in your examination tomorrow, so generally you have to just calculate that amount for this year only. Although it is allowed in 3 years, 3 years means I'm not saying that divide by 3. No, no, no. I'm saying that it is allowed in first year also, second year also, third year also. Generally, you will not get this. You will get only for this year you have to compute. So just remember that whatever is the salary which you are paying to the eligible employees, I'm using the word eligible employees. So to eligible employees, 30% is allowed. And who is the eligible employee, guys? Eligible employee is that person who is not getting, whose total salary per month is not more than 25,000 rupees. So if the employee's salary is more than 25,000 rupees, that employee is not eligible. Second thing is that employee should participate in recognized provident fund. Actually, this person should be a regular employee. He should not be a casual employee. Number of days at least he has actually recruited in this company for at least 240 days. So minimum number of days should be 240. But in case of leather business, apparel business, or footwear business, it can be reduced to 150 also. In other business, it is 240. In case of apparel, footwear, and leather business, it is 150 days. And casual employees are not allowed here. So whatever is the eligible employees, just see that how much salary you are paying to them. 30% of that amount is allowed under 80JJAA. QQB and RRB. In fact, RRB is very much similar to QQB. They both are allowed in optional regime only. They both are allowed in optional regime only. What is QQB? QQB is only for resident author who has actually written a book. So if you have written any textbook, or if you have written any article in newspaper, magazine, journal, that is not covered over here. Textbook is not covered over here. Other books, any book of literature, any book of fiction, any book of any other subject, that is allowed. So whatever is the royalty which you are getting, it is, first of all, make it your IFOS income. So whenever we receive royalty, QQB, guys, QQB is only and only for optional regime. QQB. So let's say there is a person, Mr. A, he's an author. So he is getting a royalty on books. For example, he is getting a royalty of rupees 10 lakh. And he is incurring expenses of 1 lakh rupees. He's incurring expenses of 1 lakh rupees. So first of all, make IFOS income. Make it as IFOS. You can also make it a PGBP, that does not matter, but I would recommend make it IFOS. So first of all, 10 minus 1, 9 lakh, make it as IFOS income, right? There might be some other income also, consider that as well. But for this purpose, let me take it IFOS income 9 lakh rupees. Let's say this is a GTI. Then from this GTI, you will give 80 QQB. Guys, 80 QQB is least of the two, A or B. It is least of the two. The second point is very easy. 3 lakh is the fixed limit. 3 lakh is the fixed limit. First limit is royalty income minus expenses. Royalty income minus expenses. Here the expenses is 1 lakh rupees. So expenses is okay. I will write 1 lakh rupees. Now, how much is the royalty income I have to take? Sir, we can take 10 lakh. You can take 10 lakh, but if in your question it is written that this 10 lakh is actually 20% of the value of the book sold, this 10 lakh is actually 20% of the value of the book sold. Let me make it 50%, 50. So it is 50% of the value of the book sold, this 10 lakh rupees. So while compute, see, while making your IFOS, whatever is your royalty, make your income minus expenses. Whatever is your royalty, make your income 10 lakh minus expenses 9 lakh while computing your IFOS. But right now I'm discussing about QQB. When you compute QQB, in that case, this royalty, how much you should take? It should not be more than 15%, 15% of the value of the books. So in this case, this 10 lakh is actually 50%. So how much is 15%? So what you will do, 10 lakh divided by 50 into 15. How much it is coming, guys? 10 divided by 50, 3 lakh rupees, right? So you are getting 3 lakh rupees. So this would be 3 lakh minus expenses 2 lakh rupees. Got it? Everybody understood it? So this royalty cannot be more than 50. See, if it is actually which we are receiving, if it is 10%, 12%, 15%, then it's okay. If it is more than 15%, we will restrict ourselves to 15% only. So royalty 3 lakh, 15% minus expenses 1 lakh, 2 lakh, 2 lakh or 3 lakh, whichever is lower, you will get 2 lakh rupees as a deduction in QQB. Got it? Next thing is that this royalty must be received if you are receiving it from foreign country, then this royalty should be received within 6 months from the end of the previous year. If you are receiving after 6 months, then we will not consider it over here. So only that royalty which is received within 6 months from the end of the previous year in foreign currency, that point is not that important, but 15% is something which is very important. So this was QQB. Textbook, pamphlets, newspaper, magazines are not covered. 80 RRB, same thing. Whatever we have done in QQB, it is same in RRB also. This is royalty on any other thing except books. Royalty on other royalties covered in RRB. So whatever is the royalty income minus expenses become IFOS income. Then you will get deduction also. And it is in fact very easy because that 15% point is not applicable in RRB. 15% point is applicable only for books. For RRB, 15% point is also not applicable. 80 TTA, TTB, only under optional regime, not in default regime, TTA, TTB. See, if the assessee is not a senior citizen, then only TTA he will get. If he is a senior citizen, then only TTB. We cannot take both the deduction. Some of the papers which I was checking last week, I found that some students are giving both the deductions simultaneously. TTA also, TTB also. No, 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 guys. These are mutually exclusive. Either TTA will come or TTB will come. If the assessee is not a senior citizen, resident and not a senior citizen, then TTA. But if the assessee is a resident senior citizen, then only TTB, TTA will not come. Got it? Second thing is that how much is TTA? See, it is eligible assessees, individual or HUF, other than resident senior citizen. So if there is a non-resident, can he take TTA? Non-resident, the answer is yes. If that non-resident is a senior citizen, then obviously TTA, because TTB is only applicable to resident senior citizen. I believe that you got it, right? So TTA would be only for individual or HUF, resident, non-resident, okay. For resident senior citizen, we have TTB, not TTA. So TTA will give you if you are earning saving account interest. This saving account can be post office saving account. It can be your bank saving account. It could be your any financial institution saving or a cooperative bank saving account. So generally it is bank saving account or a post office saving account or a cooperative bank saving account. So whatever is the saving account interest or 10,000 rupees, whichever is lower. So guys, I was telling you in IFOS, I was telling you about post office saving. So let's say let's say there is a person in your question, you will get that this person got actually post office saving account interest, let's say he received rupees 13,500. Correct. So first of all, how much IFOS income you will make? IFOS income would be 13,500 minus 3,500 is the flat deduction exemption available over there in IFOS. So in IFOS, you will make 10,000 rupees. Got it? If it is a joint account, deduct 7,000, otherwise 3,500. I'm not talking about bank interest. I'm not talking about any other interest. Right now, I'm talking about only and only post office interest, right? So 3,500 you will deduct. Then whatever is the other income, you will take your GTI then. And from GTI, you will also give 80 TTA. Why? Because there is a saving account interest which you are getting. So how much is 80 TTA? Whatever is the saving account interest or rupees 10,000 or rupees 10,000. 10,000 is the fixed limit. So tell me how much is the saving account interest? 13,500? No, no, no. So here the saving account interest is this 10,000. So 10,000 or coincidentally, it is also coming same. So this saving account interest or 10,000, whichever is lower. So both are same. So 10,000 is there. So how much your income will become? Zero. Understood? So 3,500 should be deducted while computing IFOS only. That too only for post office. If it is cooperative bank, if it is other bank, please do not deduct this 3,500. Then I will keep only 13,500 exactly. This 3,500 should be deducted only for post office saving account. Understood? And TTA would be saving account interest or 10,000, whichever is lower under optional regime. If the assessee is a resident senior citizen, then TTB, then it would be TTB. TTB not only for saving account interest, it could be for any other bank account interest also. It could be FD, it could be recurring deposit, it could be any other deposit also of bank. So here, first of all, this should be a resident senior citizen, 60 years or more. Amount of deduction is the amount of interest on deposit. It could be saving account also. It could be any other bank account, FD, recurring deposit, or any other deposit also. That amount of 50,000, whichever is lower, you will get this deduction. 80U, we have already done. Okay, last main chapter which is left is TDS. Some half an hour more we have to diff. Okay. Yes, can we take a 5 minutes break? Is it okay to take a 5 minutes break, or do you want 10 minutes break? Tell me. Or should I continue? No, I'll not be able to continue. At least I need some 5 minutes break. 10 minutes. Okay. Okay, let us take 10 minutes. Then I'll be taking, I think 40 minutes more, 40, 45 minutes more I'll take, and then I'll wrap up, because this is the last main chapter which is left. Then there is very small chapter, TCS, advanced tax and return of income. That will not take much time. So I think 10 minutes break will take. Aparna will take 10 minutes and we'll resume. It is 9:48. Okay, let us resume at 10 o'clock, 10 p.m. Okay, let us resume at 10 p.m. Okay. Okay. Let us come to the next chapter, TDS. TDS on salary. Generally, I don't see section 192 coming in examination, but you understand that on TDS on salary, there is no such rate. It depends on the salary income of the employee, that what is the salary income which he is getting. Then we have to compute the tax on the salary income, and that should be divided by 12. So generally, you will not get this section 192. I have not seen this section 192 coming in examination. But yes, section 192A, premature withdrawal from EPF. This is an important point, that whenever we withdraw from employee provident fund, premature withdrawal is that before 5 years, if we withdraw from RPF, then the rate of TDS is 10%. So whatever we withdraw from the from RPF, 10% deduction would be there on TDS. The threshold limit is 50,000. So please only remember two things: that premature withdrawal of RPF, 10% is the rate. Threshold limit is 50,000 rupees or more. So whenever, if we are getting premature, see, if we are getting from RPF after 5 years, then it is exempt. Then if it is exempt, there is no TDS. But if we are getting withdrawal before 5 years, then please deduct 10% TDS if the amount is 50,000 rupees or more. Section 193 is interest on securities. Rate of TDS would be 10%. So 10% interest on securities. Second thing which you should remember is that the limit is 5,000 rupees. The limit is 5,000 rupees. But if it is government bonds, government saving taxable bonds, the limit would be 10,000. Generally 5,000. But in case if it is taxable saving bonds or a floating rate bonds of government, then 10,000 is the limit. Uh, Generally for government securities, there would be no TDS. See, actually there are sections like section 193, 194 and 194A and 194. So here 193 is interest on securities. 194A is interest other than securities. And 194 is dividend income. The rate of TDS is common in all these three sections. So if you are getting interest on securities, and what is interest on securities? That let's say person is having a debentures or any other securities, then TDS will be deducted. The rate of TDS is 10% in all these three sections. Got it? Second thing is that if you are getting interest on securities, the threshold limit is 5,000. So if you are, let's say if you are having debentures, and if you are getting interest on debentures, if the amount is more than 5,000, 10% TDS will be deducted. In case if it is government securities, then no TDS will be deducted on government securities except taxable saving bonds. On taxable saving bonds, floating rate bonds, there is a threshold limit of 10,000 rupees. But I want you mostly please remember 10% is the TDS rate. 5,000 is the limit generally. Just on taxable saving bonds, the limit is 10,000 rupees. Next important, but 193 is not that important. But however, this 194 is little more important. Most of the time, examiner asks about 194A. This is other than securities. So whenever you receive interest from other than securities, now, if you are receiving 194A, let's say from 194A, if you are getting it from any bank, if you are getting this interest from any bank, post office or cooperative bank, if you are getting interest, then 10% TDS rate will be deducted. The threshold limit is 40,000 rupees. The threshold limit is 40,000 rupees. In case the assessee is a resident senior citizen, the threshold limit would be 50,000. This is important, guys. Please do remember the threshold limit in case of other interest, other than interest on securities. The limit is 40,000, 50,000. But if you are getting other interest, if you are not getting from bank, cooperative bank or post office, but let's say you have given a loan to someone and those people are actually paying you interest. So if you are getting other interest, the TDS rate would be 10% and the threshold limit is 5,000 rupees. This one, from examination point of view, if you ask me, this much is not that important, but this is something which is important. So if you are getting from bank, post office, cooperative bank, 40,000 is the limit. In case of resident senior citizen, 50,000 is the limit. And let's say if you are getting it from different branches of the bank, but it is same bank. Let's say you are getting it from SBI, SBI Chennai, SBI Coimbatore, SBI Madurai, then it is one bank. You have to do the aggregate of all these things. If the aggregate of all exceeds 40 or 50 as the case may be, then TDS would be applicable. So this is section 194A. The rate of TDS is 10%. 40,000 is the limit. In case of senior citizen, 50,000 is the limit. And if it is other interest paid by others, if it is not bank, cooperative bank or post office, if it is others, then 5,000 is the limit. Right? This is important. 194, that is TDS on dividend. TDS on dividend, it is very easy. 10% is the TDS rate and the threshold limit is 5,000. Is same like 194, we have one more section, 194K. Not that important, but it is same like dividend. However, 194K is income on mutual fund units. So if you are earning income from mutual fund units, then you will again TDS would be deducted at a rate of 10% and the threshold limit is 5,000. So how you should learn it? 194 dividend and 194K is almost same. 10% is the rate of TDS, 5,000 is the threshold limit. This is dividend on shares. This is income on mutual fund units. Got it? Next section is 194B, double B and BA. Again, three sections which are very similar. Section 194B, 194BB, and the new section which came last time is 194BA. 194B is for casual income. If you earn casual income or any income from game show or any other quiz, etc. But if it is online gaming, initially it was one section, but last year they have made a separate section for online gaming. For online gaming, now we have section 194BA. 194BB is specifically for horse race winning. For horse race winning, it is 194BB. Guys, 194B and double B is very, very similar. The tax rate, TDS rate would be 30%. 30% here, 30% here. And in fact, here also for online gaming, it is 30%. The TDS rate would be 30% in all the three cases. Second, the threshold limit is 10,000 here, 10,000 here. But here there is no threshold limit. For online gaming, there is no threshold limit. So please remember these two things in 194B and double B for casual income or for horse winning also. TDS rate is 30%. The threshold limit is 10,000, 10,000. However, in case of online gaming, there is no such limit. And this 30% is on net winning. 30% deduction is on net winning. What is net winning? What is net winning? So net winning is equal to, so let's say you have withdrawn rupees 1 lakh from your online gaming account. And if you have deposited rupees 10,000, it means that 90,000 you have is your net winning. So whatever is your withdrawal, so let's say 90,000 you have, let's say 1 lakh you have withdrawn and you have deposited 10,000 rupees. So your net winning is 90,000. So on 90,000, you have to pay 30% TDS. So 30% TDS would be applicable on it. Net winning is also is your closing balance at the end of the year minus opening balance. This is also your net winning. So let's say you have not withdrawn anything, you have not deposited anything during the year, but let's say at the end of the year, you have a closing balance in your online gaming account, let's say rupees 40,000, and opening balance was, let's say 5,000. You have not deposited anything, you have not withdrawn anything. It means that this year you have actually played some games and you have won 35,000 rupees. So this is also the net winning. So if I'll do the total of this, if both the equation, I'll do the total. So what I'll get withdrawal plus closing balance, this plus this, minus deposit minus opening balance. You don't have to learn this particular formula, but this is quite logical. So first of all, what I have done is I've breaked it into two parts. Withdraw minus deposit, it is with net winning. Closing balance minus opening balance is the net winning. Then I have combined these two. Withdrawal plus closing balance minus deposit minus opening. This is the net winning. On this net winning, 30% is the TDS rate. Got it? So these three sections, 194B, 194BB, 194BA, the common thing is that 30% is the tax rate. 194C is the payment to contractor. Is the payment to contractor. Again, an important point. 194C is an important deduction. So if you are paying to a contractor, then the TDS rate would be either 1% or 2%. So it depends the person who is receiving the money. The person who is receiving the money, that is the contractor. The contractor who is receiving the money. If this contractor is individual or HUF, then the TDS rate would be 1%. So we are paying money to the contractor. We are paying the money to the contractor. If this person is an individual or HUF, the rate of TDS would be 1%. If this contractor is any other person, then the rate of TDS would be 2%. Got it? Third thing which you should remember is the threshold limit. The threshold limit for single contract is 30,000. So if I have given this money to a contractor and this contract amount is not more than 30,000 rupees, then there would be no TDS. But if the contract amount is more than 30,000 rupees, then I will deduct TDS. So if the single contract is 30,000 rupees, but let's say this contract is not more than 30,000, but again and again, I'm giving the contract to this contractor. Let's say there is a multiple contract. So in case if there is a multiple contract, so what I'll do the aggregate of all the contracts. I will do the aggregate of all the contracts. And whenever this aggregate exceeds 1 lakh rupees, then TDS will be deducted. 1% or 2% depends on the contractor. The person who is receiving, that person is an individual or HUF 1%, otherwise 2%. Again, I'm repeating, the threshold limit is 30,000. In case of multiple contracts, if the aggregate exceeds 1 lakh rupees, then you will deduct TDS, right? So let's say, for example, the first contract we have given, it is 25,000. There would be no TDS. Second contract which we have given is 29,000. There would be again no TDS. Why? Because the single contract is not exceeding 30 and the aggregate is also not exceeding 1 lakh rupees. Third contract we have given is 20,000. There would be no TDS. And let's say, let me increase it. Let's say 26,000. There would be no TDS. And the fourth contract we are giving, let's say it is 28,000. Now, if you look at it, in fact, each contract is not more than 30, but if you will aggregate, what is the aggregate of this? 25 plus 29 plus 26 plus 28. It is 108. 1,08,000. The aggregate is exceeding 1 lakh rupees. Now TDS would be applicable. Now it depends. The person who is receiving it is an individual or HUF. If it is individual and HUF, now deduct from the fourth amount whenever you will pay. See, here you will pay entire 25,000 without TDS. Here you will pay entire 29. Here you will pay entire 26. But here, when you will be paying amount, then deduct. Let's say that contractor is an individual. Deduct 1% TDS. 1% means 1080 you should deduct. So out of this 28,000, deduct 1080, then pay him the amount. Correct? Now, who is the TDS deductor? The TDS deductor. So TDS deductor can be any person. It can be any person other than individual or HUF. So a company, when they are paying to contractor, a partnership firm, when they are paying to a contractor, the TDS deductor can be any assessee. But in case of individual or HUF, see, generally individual and HUF can only deduct TDS if they are big individual HUF. What is big individual or HUF? if the last year turnover of business is more than 100 lakh, last year turnover, not of current year turnover, last year turnover, that is previous year 23-24. Last year turnover is more than 100 lakh if they are carrying a business, but if they are carrying a profession, the last year turnover is more than 50 lakh rupees. Then they are supposed they're eligible to deduct TDS. But let's say their last year turnover, the individual ratio of last year turnover is not more than 100 lakh or 50 lakh as the case may be, then they will not deduct TDS. Understood? This is the important point. Individual or HUF can deduct TDS if they are big individual or HUF. If they're small, they will not deduct TDS. Understood this point also? Guys, mostly you will find that TDS deductor is any other person other than individual HUF. Individual HUF are only eligible if their last year turnover is more than 100 lakh or 50 lakh rupees as the case may be. But there are three sections where small individual HUF can also deduct TDS. Okay. So this was 194C. Then 194D, 194G and 194H are quite similar sections. These are all related to commission and brokerage. 194D, 194G, 194H. See, 194D is insurance commission, 194G is lottery commission, and 194H is other commission and brokerage. Other commission and brokerage. The threshold limit in all three is 15,000, 15,000, 15,000. The threshold limit is 15,000, 15,000, 15,000. The rate of TDS is generally it is 5%. It is 5%. Here also it used to be 5%, 5%. But there is an amendment over here. There is an amendment over here in 194G and 194H. Up till 30th September 2024, it was 5%, 5%. And generally most of the 5%, it has reduced to 2% now. So now the TDS rate in 194G, it is 2%. In 194H also it is 2%. So let's say if you are paying this amount after on or after 1st October 2024, then please apply 2%, 2%. Before that, it was 5%, 5%. Got it? See, in 194D, there is no change. It is still 5%. But please also remember that if this is insurance commission, if we are paying an insurance commission to a company, that agent is a company, then the rate of TDS will become 10%. Not that important, but please do all remember this also at the back of the mind, that if this insurance commission under 194D, we are paying to an insurance company, that agent, see who pays insurance commission? Insurance company pays to the insurance agent. If that insurance agent is a company, then 10% TDS would be applicable. Got it? So this is 194D, 15,000 is the limit, 5% or 10%, 10% in case the deductee. Deductee means the receiver is a company. 194G, 15,000 is the threshold limit, 2% is the rate of TDS now, but earlier till 30th September 2024, the rate of TDS was 5%. 194H, 15,000 is the limit, 2%, earlier it was 5%. Got it? 194DA, life insurance premium. See, if it is, I have already told you in IFOS, if it is a low insurance premium, see, life insurance premium. This is important. This is an important section, 194DA. This is an important section, life insurance premium. See, first of all, if it is a low insurance premium or it is a high insurance premium, first you have to identify whether it is a low insurance premium or a high insurance premium. How you will identify that we have already discussed in IFOS also. So it depends on the date. I have given you the date of 1st April 2012. So I have given you that if the premium paid is more than 20%, it is high insurance policy. But if it is up to 20%, then it is a low insurance policy. Then I have also said to you that for next 1 year, it was 10%. And then after 1 year, it was 10% for all policies, but for physically handicapped, it is 15%. So 10%, 15%, 20% is actually the parameter. If the annual premium is up to this is a low insurance policy. Low insurance policy is an exempt policy. So whenever you will receive this sum, it is exempt. Correct? So if it is exempt, then obviously there is no TDS. In that case, see something which is exempt, then we will not deduct any TDS. However, if it is a high insurance policy, what is a high insurance policy? First of all, you have to determine whether 20%, 15%, or 10%, whatever is applicable to it. Generally, if the question is silent, please apply 10%. And if the annual premium is more than 10%, it is a high premium policy. High premium policy is taxable policy. High premium policy is a taxable policy. Got it? Here, 194 DA says that the TDS rate would be, earlier it was 5%, earlier it was 5%, now it is 2% from 1st October 2024. So if you are getting money from a high premium policy after on or after 1st October 2024, please apply 2% rate of TDS. Before that, you should apply 5% rate of TDS. Generally, whenever these rates are changed during the year, generally they will give you the period which is related to the new period, that is on or after 1st October 2024. So whenever you are receive this money, 2% TDS will be deducted, but there is a threshold limit. First of all, the money which you are receiving, the threshold limit is rupees 1 lakh. The money which we are receiving should more than 1 lakh, right? Then you will apply 2% or 5% as the case may be. So TDS would be 2% on income component. 2% on income component. What is income component? See, 2% of whatever the actually the amount which you are receiving at the time of maturity or surrender, whatever your amount you are receiving at the time of maturity, minus whatever is the premium you have paid over the life of this policy. That is the income component. See, let's say if you have taken a policy and you are paying 1 lakh, 1 lakh, 1 lakh rupees for 5 years. So you have paid 5 lakh rupees. But at the end of maturity, let's say you are getting 7 lakh rupees. So 7 lakh minus 5 lakh, 2 lakh is the amount of income component. So TDS will be deducted on the income component. Got it? So please remember this 5% or 2% will be deducted only on the income component. And also, if the amount which you are receiving, it is more than 1 lakh, then only TDS would be applicable. Otherwise, TDS would not be applicable. Let's say, for example, it's a high premium policy. And on the amount, the maturity amount, it's a high premium policy. Guys, high premium policy is a taxable policy. How it should be taxable under IFOS. But let's say your question will tell you it's a high premium policy. So they will not, please don't use the word high premium or low premium in your answer. Please use the word 10%, 15%, or 20% as the case may be, right? So let's say it's a high premium policy and on maturity, you are receiving 90,000 rupees. On maturity, you are receiving 90,000 rupees. Correct. And the premium which you have paid, let's say it's a 4 or 5 years policy and the total premium you have paid is 60,000 rupees. So how much is the income which you generated? Your income component is 90,000 minus 60,000, 30,000. So can we deduct TDS on this 30,000 rupees? The answer is no. Why? Because TDS would only be applicable if the amount which you are receiving on maturity or on surrender. So here, the amount which you are receiving is 90,000 rupees. It is not more than 1 lakh. So if this would have been more than 1 lakh, then TDS would apply. In this case, I will not apply TDS because the amount which you are receiving is not exceeding 1 lakh rupees. This is 194 DA life insurance policy. Then 194I, TDS on rent. This is also an important section, TDS on rent. The rate of TDS is 10%, but if it is for plant and machinery, the rate would become 2%. So if you are paying rent, then 10% TDS you should deduct. But if you are paying rent of plant and machinery, then 2% you have to deduct. And the threshold limit is 2,40,000 rupees. Please remember, let's say in your examination, how you get this question. Let's say there is an assessee, Mr. A, and Mr. A is paying rent. Mr. A is paying rent. And let's say this rent is 30,000 rupees per month. He's paying a rent for his shop. for his business, he's paying a rent. 30,000 per month, he's paying a rent. So 30,000 per month into 12, this is 3,60,000 rupees. It means that yes, the amount is more than the threshold limit is more than 2,40,000 rupees. So yes, TDS should be deducted. So every month, so whenever we will be paying 30,000 rupees every month, we will be deducting 10% TDS because it is for building or furniture 10%. If it is for plant and machinery, then 2%. So every month, or you can actually tell that for the entire year, we will be deducting 10% TDS, that is 36,000 rupees. And if you would like to show it monthly, then 30,000 into 10, 3,000 TDS will be deducting it every month. Correct. Now, who is paying this rent? Mr. A. Mr. A is a deductor. So generally 194I is only applicable to other assessee. It is not applicable to individual HUF, only to big individual HUF. So let's say Mr. A, his turnover of the last year was more than 1 crore of business or 50 lakh of profession, then only 194I would be applicable. Understood? So if this person is an individual, his turnover of the last year is more than 1 crore or 50 lakh as the case may be, then only 194I would be applicable. Otherwise, 194I would not be applicable. Got it? Now, we have a similar section 194IB. That is also for rent. That is also for rent. But this is only for the deductor who are individual HUF who are not covered under 194I. Why? Because in 194I, only big individual HUF are covered. But in 194IB, small individual HUF are covered over here. So this section is only for small individual HUF if they are paying rent. But the rent which they are paying is quite significant. It is more than 50,000 rupees for a month. So if you are a small, this section is important, guys. 194IB, we have discussed in detail in the classes. So 194IB is small individual HUF who is paying rent even today. So let's say if this business turnover is less than 1 crore or 50 lakh as the case may be, or let's say even this individual is a salaried assessee who does not have even the turnover, but the rent which he is paying, it is more than 50,000 rupees of a month or part of the month, then they will be deducting TDS. But 194B is only for small individual ratio, so we will actually not bother them. We will only give them very easy compliances. So we will say that at the end of the year, you have to deduct TDS. At the end of the year, you have to deduct TDS. Or let's say at the end of the year means that in the month of March, you have to deduct TDS. Or let's say if you are vacating this house or any other property before that, so even you should deduct TDS at the end of the year, or it could be in the last month of your tenancy. So let's say somebody is vacating that property in the month of December, then TDS would be deducted in the month of December. Got it? Now, whatever is the rent which you have paid during the year, if it is more than 50,000 rupees per month, deduct TDS. How much is the TDS? The TDS, again, there is a change over here. Up till 30th September, it was 5%, but now it is 2%. Now from 1st October, it is 2% on the rent which you have paid during the year. So this is 194IB. See, the rate of TDS was 5% earlier, but now it is 2%. And the payment by individual HUF whose turnover is less than 1 crore or 50 lakh, because if your turnover is more than 1 crore or 50 lakh, then 194I would be applicable. But if your turnover is less than, even I would say, even you don't have the turnover, if your assessee is a non-business assessee, let's say salaried assessee or any other assessee, and he is paying rent, and the rent of per month is more than 50,000 rupees, then TDS will be deducted at the last of the year, at the last month of the year, or last month of tenancy, as the case may be. Right? 194IA, whenever you purchase an immovable property. So whenever you purchase an immovable property, if it is of rupees 50 lakh rupees or more, 50 lakh is the threshold limit, then you should deduct TDS 1%. So this is an important point, but very, very easy section. Please do remember 1% TDS. If the buyer is purchasing it for rupees 50 lakh rupees or more, then 1% would be the TDS. 194J, again an important section. 194J is applicable whenever you pay for professional fees, whenever you pay for technical fees, whenever you pay for royalty, whenever you pay for non-competing fees, whenever you pay for your director fees. So if it's a company and they are paying to the director, then also 194J would be applicable. So 194J For technical services, for professional services, for royalty, for director fees, for non-competing fees, TDS would be applicable. The threshold limit is 30,000 rupees. The threshold limit is 30,000 rupees for each type of services separately. For professional services, please keep 30,000 separate. For technical services, please keep 30,000 separate. For director fees, sorry, for non-competing, for royalty, keep 30,000 separate. But for director fees, there is no such limit. For director fees, guys, there is no such limit. So even if you are paying to a director rupees 10,000, 15,000, 16,000, doesn't matter. Please apply TDS rate, right? The rate of TDS is generally 10%. 194J, generally, if you ask me, the rate is 10%. But in case of only few things, the rate of TDS would be 2%. Generally, for professional services, for royalty, for director fees, for non-competing fees, the rate is 10%. For technical services, the rate of TDS is 2%. Second, if it is royalty, royalty rate is 10%. But if it is royalty in the case of cinematographic films, then it will become 2%. Not that important. Generally, please remember 194J, it is 10%. In case of technical services, it is 2%. This is something which you should remember. 30,000 is the limit. And this is very, very important. If you are paying director fees, then there is no such limit of 30,000 rupees. 194K we have discussed. This is income on mutual funds. 194 LA. 194 LA is a very, very easy section and important. Whenever you are paying for compulsory acquisition of immovable property, 10% TDS will be deducted. The threshold limit is 2.5 lakh. Please remember only two things. 10% is the TDS for acquisition of immovable property. 2.5 lakh is the limit. 194M, again an important section. It is for individual RHUF whose turnover is not more than 1 crore or 50 lakh as the case may be. That is for a small individual RHUF. Or even if you don't have a turnover, you are a salaried assessee or any other assessee, then also 194M would be applicable. So here the TDS rate of 194M would be, earlier it was 5%, now it is 2%. If you are paying more than 50 lakh rupees, if you are paying more than 50 lakh rupees, you are a small individual RHUF, the assessee is a small individual RHUF, and you are paying for a contract, you are paying for professional services, or you are paying for commission and brokerage. This is an important section, guys. 194M. The rate of TDS would be 2%. Earlier it was 5%. Up till 1st October, from 1st October onwards, 2%. Before that, it is 5%. And if you are paying for a contract, you are paying for professional services, you are paying for commission brokerage, but a very significant amount you are paying more than 50 lakh rupees, then 194M would be applicable. 194N. 194N is actually for cash withdrawal. So if you are withdrawing cash, then the TDS rate would be 5%. The TDS rate would be, sorry, see, 194N. Section 194N is for cash withdrawal. If you are withdrawing cash from bank or cooperative bank, post office, then 194N would be applicable. The TDS rate depends that whether you are filing your return on time or you are a non-filer. If the person is filing their return of income on time, which return of income? Last 3-year return. So all last 3-year return, but if they are furnished on time, then this person will count as a filer. Actually, this person is actually complying the provisions, then he will be in this category. Otherwise, if last 3-year return, but any of the last 3-year return is not filed on time, this person will come in non-filer category. Please remember that if the assessee is in this category, he is actually complying with all the provisions, then from 0 to 1 crore, there is no TDS. 0 to 1 crore, there is no TDS, and more than 1 crore. So I can say from 1 crore and above, it is the rate of TDS would be 2% in that. Understood? Second thing, if the person is a non-filer category, then 0 to 20 lakh. From 0 to 20 lakh, no TDS. But from 20 lakh till 1 crore, 2% TDS. And more than 1 crore, there would be 5% TDS. More than 1 crore, there will be 5% TDS. So you all know that it is like a slab rate over here. So if you are filing your all last 3-year returns on time, So last 3 years, we have to see that which year whose due date has expired. So if the last year due date has not yet expired, so we will not see this year, we will go one more year back. I believe that you are able to recall this provision also, whose due dates was expired. So 0 to 1 crore, no TDS, 1 crore to infinity, 2%. But in this case, if you are non-filer category, after 20 lakh, we will be deducting your TDS. If the person who is withdrawing the money, if that person is a cooperative society, the person who is withdrawing the money, that person is a cooperative society. In that case, 1 crore limit would be replaced by 3 crore rupees. Correct? So here, 0 to 3 crore, no TDS, 3 crore to infinity, 2% TDS. If that cooperative society is a non-filer, see, 1 crore would be replaced. So 0 to 20 lakh, no TDS, 20 lakh to 3 crores, 2%, more than 3 crores, 5%. This is 194. And Rafety 194 IB for the previous year, both 5 and 2% based on date. Rafety, in 194 IB, I am telling you, in 194 IB, see in 194 IB, what will happen is you will be deducting the TDS, let's say at the end of the year. So at the end of the year, so it means that this is previous year 24-25, right? So generally you will be deducting the TDS on 31st March 25. See, 31st March 25, what rate you will apply? 2% on the entire amount. On the entire amount which you have paid, 2% you will apply, right? Although I think that you are confused that, sir, there are some months which belongs to this particular period also, April, May, June, July till September. But still, when you are deducting the TDS, that is important. So you are deducting the TDS on 31st March 2025, 2% would be applicable. Let's say the last month of the tenancy is December 25, then also 2% would be applicable on the entire amount. 2% would be applicable. Got it? But let's say the last month of tenancy is September 24. If the last year of tenancy is last month of tenancy is September 24, then 5% would be applicable on the entire amount. Revti, is your doubt clear? So you might be confused that there are some months which belongs to before September, does not matter. So it depends when you are deducting the TDS. If you are deducting the TDS after 1st of October, 2%. If you are deducting the TDS before 1st October, then 5%. Okay. 194P, 194 is not that important section. It is only for senior citizen, and that to a very special senior citizen who are at least 75 years of age. Actually, it is a relaxation to these very old people who are at least 75 years or more. They have only pension income. Plus they might have interest income also. That's it. Not any other income. If they have only pension income, these are very old people, 75 years or more, very, very old people. Now they are not able to file their return. So we are giving them an advantage. So let's say if you have an account in only one bank, Let's say you have an account in SBI. In SBI, you are getting pension. In SBI, you are earning interest also. You have only two types of income and you have not multiple bank accounts. It's not like that you have a bank account in SBI, you have bank account in ICICI, you have bank account in HDFC. No, it is not for you then. You should have a bank account only with one bank and your income is only pension income or interest income. Then what will bank do? Bank will calculate your total income and they will deduct your TDS on that at the average rate. So there is no such rate. Only the thing which you should remember in 194P is that these people are not required to file the return of income. If the bank has deducted the TDS, there is a relaxation that these people are not required to file their return of income. This is the only thing which you should remember about 194P. 194Q. 194Q is actually whenever there is a buyer, See, there is a similar section in TCS also. So if, let's say, section 194Q, and there is a section in TCS also, 206C, I believe 1H. Yes, 206C 1H. Even if you don't remember the section, doesn't matter. So see, in 194Q, it says that if there is a buyer whose turnover of the last year, is more than 10 crores, whose turnover of the last year is more than 10 crores, there is a buyer and he is actually giving the money to the seller. And during this year, this buyer has purchased the goods more than 50 lakh rupees. This buyer has purchased the goods of more than 50 lakh rupees. Then TDS will be deducted. At 0.1%. Then TDS would be deducted at 0.1%. This is an important section. Provided the buyer turnover in the last year is more than 10 crore. The buyer turnover is more than 10 crore. And if you are purchasing something which is more than 50 lakh rupees from the seller, then TDS of 0.1% in excess of 50 lakh, in excess of rupees 50 lakh would be deducted. Understood? It in excess of 50 lakh. So it means that if you have purchased 55 lakh rupees of goods, then 0.1% of in excess of 50 lakh of 5 lakh, you will deduct TDS. Understood? Second thing, the same section is in 206C1H in TCS. If there is a buyer and seller, and the seller turnover of the last year is more than 10 crore, the seller turnover is more than 10 crores, and he's actually selling something which is more than 50 lakh, then he will collect TCS at a rate of 0.1% in excess of 50 lakh, in excess of 50 lakh. So he will collect TCS. Now there is a contradiction in these two, because here the buyer will deduct TDS and here the seller will also collect TDS. So it says, see, let's say there is a buyer, there is a seller. Let's say buyer turnover is more than 10 crore and seller turnover is not more than 10 crores. Then TDS section will be applicable. 194Q would be applicable. Let's say if the buyer turnover is not more than 1 crore, but seller turnover is, turnover is more than 10 crores. So if seller turnover is more than 10 crore, buyer turnover is not more than 10 crores, then obviously TCS would be applicable. Got it? The problem will arise when buyer turnover is also more than 10 crores, seller turnover is also more than 10 crores, then TDS or TCS will contradict between each other. Then they will say that TDS will be applicable 194Q. 206C 1H will not be applicable. Then in that case, if both your turnover is more than 10 crores, then only 194Q would be applicable. And obviously, if none of the turnover is more than 10 crores, nothing would be applicable in that case. Understood? So this I should not discuss. In these three cases, you should know that here only TDS, only TCS, but here actually both of them are getting applicable. So only TDS would be applicable. Yeah. Rajalakshmi, actually, yes, in 194Q, in 194Q and 194N, these are the two sections where if it exceeds the threshold limit on excess amount only, you will deduct TDS. In 194Q, if it is exceeding 50 lakh, this is the section. And in 194N, let's say it is the cash withdrawal is more than 1 crore, then in excess of 1 crore, you will deduct the TDS. So these are the two sections where when the amount is going beyond that threshold limit, on that excess, you are deducting the TDS. And yes, on all other sections, you deduct the TDS on the full amount. Got it? So your question is correct. It is not just one section 194Q, it is 194N also. Okay, this was 194Q, and we have one more section which is not that important, 194R. 194R is for the people who are actually having PGBP income. Those people who are having PGBP income and they are receiving gifts. They are receiving gifts in the course of business. So you understand, let's say if any person is having PGBP income and they are receiving gifts from their clients, from their customer, so this is covered under section 28. It is taxable under section 28. It is PGBP income. But most of the people were not showing this income. Most of the people were not showing this income. They were getting the gift, but they were not showing it. So 194R says that now the TDS rate would be 10% if whatever the gifts which you are receiving is more than 20,000 rupees. If it is more than 20,000 rupees, then 10% TDS will be deducted. So let's say if today you will be receiving a gift of 50,000 rupees in the course of your business and profession, then 10% TDS on 50,000 on entire amount, 5,000 TDS will be deducted. Understood? So generally, examiner can ask you, let's say there is a social media influencer who is having a PGBP income. This is a social media influencer. So let's say he's promoting any brand. So let's say there is a mobile phone company and they are paying, they are giving a mobile phone. They are giving a mobile phone to this social media influencer. This is YouTuber. This YouTuber is having a PGBP income. So this mobile phone company is giving a mobile phone to this person. And let's say the value of this mobile phone is more than 20,000 rupees, then TDS, this mobile phone company is supposed to deduct TDS at a rate of 10%. Got it? But let's say if this YouTuber, they are giving this mobile phone just for review of the phone and then they will take it back, then obviously it is not a gift then. If they will take it back, then it is not a gift. But they will say, okay, this to this influencer, they are saying that, okay, review our phone and also you can keep this phone with you. Then it is a gift in the course of business and profession, then 10% TDS would be applicable, right? So this is 194R. So these are the important sections of TDS. In TCS, if you ask me, uh, alcoholic liquor, just remember for scrap, mineral, timber, you don't need to remember the percentage. Just for alcoholic liquor for human consumption, the TCS rate is 1%. Parking toll plaza, not that important. It is 2%, not that important. TCS on motor car, this is important. This is important. TCS on motor car. So the TCS on a motor car, it is 1% if you are purchasing any motor car. If you are purchasing any motor car of more than 10 lakh rupees, any car which you are purchasing, four-wheeler, I'm not talking about two-wheelers, I'm talking about four-wheelers. So if you are purchasing any motor vehicle which is exceeding 10 lakh rupees, the person who is selling you the motor vehicle, they will collect 1% extra. So let's say today, if you go to purchase a car of rupees, let's say 15 lakh, they will take 1% extra. That is 15,000 they will take extra from you. So you have to pay 15 lakh plus 15,000 to them as a TCS. So please remember 1% is a TCS rate and the value should be more than 10 lakh. This is actually who would be collecting is the dealer who are actually selling it to the consumer, the dealer who are actually selling it to the consumer. But let's say these dealers are purchasing motor car from the manufacturer. So let's say there is a manufacturer Maruti. Maruti Suzuki is the manufacturer, let's say. They are selling this car to the dealers. Then TCS will not be collected. When these dealers are selling it to the consumers, then TCS will be collected. Got it? So here in this case, actually, the income tax department would like to trap the people who are actually spending more on cars. So whenever the dealer would be purchasing from Maruti, TCS will not apply. But when this dealer is actually selling it to the consumer, then TCS would be applicable. Now, sale of goods value exceeding 50 lakh that we have already discussed, 206C1H. This is important in TCS. This is the last one in TCS, but this is important in TCS for overseas tour operator. For overseas tour operator, so let's say if the person is going outside India or he has purchased a tour package from a tour operator, so up to 0 to 7 lakh TCS, that operator, that tour package operator, that agent will collect TCS from you. From 0 to 7 lakh, guys, it is important. These both of them are important. So let us first discuss about overseas tour operator. So if the tour or the package is uh, up to 7 lakh rupees, then 5% TCS will be collected. From above 7 lakh, it is 20%. So let's say you are going outside, let's say you are traveling to Europe and you have purchased a package of rupees, let's say 12 lakh. So on first 7 lakh, the TCS rate would be 5%. And in excess of 7 lakh, In excess of 7 lakh, it is 5 lakh. The TCS rate would be 20%. So 7 lakh into 5%, it is 35,000. 5 lakh into 20% is it is 1 lakh rupees. 35,000 and 1 lakh, 1 lakh 35,000 he will collect this very, very high rate of TCS. But yes, that tour operator will collect 1 lakh 25,000. Have you all understood? 1 lakh 35,000 up to first 7 lakh rupees, 5% TCS, above 7 lakh, 20% TCS. If if you are purchasing foreign currency, it means that you are remitting foreign currency outside India, then TCS will be collected. But please remember, whenever in case of foreign currency transaction, whenever you are remitting outside India, up first 7 lakh, there is no TCS. On first 7 lakh, there is no TCS. Please remember, don't confuse yourself. In overseas tour operator, first 7 lakh was also, there is a TCS of 5%. But here, for foreign currency, first 7 lakh, there is no TCS. In excess of 7 lakh only, there would be TCS. In excess of 7 lakh only, it is TCS. Now it depends that why you are remitting this money outside India. If you are remitting this money for education purpose or for medical purpose, if the person is remitting the money for education purpose or medical purpose, then 5% in excess of TCS, 5% in excess of 7 lakh rupees. If you are remitting it for education purpose by taking a loan, in that case, it would not be 5%, it would be 0.5% in excess of 7 lakh. Understood? For education and medical purpose, it is 5%. But if you are remitting it for education purpose by taking a loan, then only 0.5% would be there. But if the person is remitting outside India, it is not for education, for medical, it is not for medical, it is not for education loan, etc. For other purpose, that is for luxury purpose or any other thing, then 20% is the TCS rate in excess of 7 lakh. But please remember, in all the three cases, up till 7 lakh rupees, no TCS. Up till 7 lakh rupees, no TCS. In excess of 7 lakh only, this 20%, 0.5%, 5%, whatever is the case, it is in excess of 7 lakh rupees. So this was TCS. The next is advanced tax. See, advanced tax provision is applicable to the assessee if their advanced tax liability is 10,000 rupees or more. If their advanced tax liability is 10,000 rupees or more. What is advanced tax liability? See, first of all, we have to calculate our tax liability. Whatever is my tax liability minus TDS minus TCS. This is called advanced tax liability. If this advanced tax liability is 10,000 also or more, 10,000 or more, then advanced tax provision is applicable on you. However, there is an exception if the assessee, this is an important, if the assessee is a senior citizen, if the assessee is 60 years or more resident senior citizen, and if this person advanced tax liability is coming more than 10,000 rupees also, but if this person is not having PGBP income, if this person is not having PGBP income, in that case, there is no provision for advance tax on this person. So please remember, they are giving a relaxation to senior citizen. If you don't have a PGBP income, then we are saying, okay, don't pay advance tax. No issues for you. But if the person is a resident senior citizen, but still he is getting PGBP income, then advance tax would be applicable. Got it? Now you understand that how advance tax should be paid. So advance tax should be paid in four installments. First installment is 15th June during the previous year itself. 15 June, 15 September, 15 December, 15 March. That is a gap of 3 months each. And here up till 15 June, you should pay at least 15%. Till 15th September, at least 45%. Till 15th December, at least 75%. Till 15th March, at least 100% should pay. If you will not pay your advance tax liability, so whatever is the short payment, 234C interest would be applicable. 234C interest would be applicable. It is applicable at a rate of 1% per month. 1% per month. And for first three installment, it is fixed 3 months, 3 months, 3 months. And last installment, it is 1 month. Last installment, it is 1 month. Got it? One more thing, that 234C interest is giving you a relaxation. In first two installment, it gives you relaxation. That is again important point. If although first installment we require 15%, but they are saying that even if you deposit 12% also, we will not charge 234C in the first installment, correct? And the second installment, although you are supposed to pay 45%, but even if you pay 36%, even if you pay 36%, then also we will not take interest on 234C. But in third and fourth installment, here there is no relaxation. We need 75%, we need 100%. So this is 234C. I'm again repeating, 234C interest is 1% per month, 1% per month. And for first 3 months, it is fixed 333, and last it is 1 month. Got it? The people who are taking the presumptive income section 44AD and 44ADA, I'm not saying 44A, no, 44AE, that is for motor vehicle, that is for actually goods transport vehicle. The people who are taking 44AE, all four installment are applicable on them. But the people who are taking 44AD and 44ADA, only one installment is applicable, the last installment. They don't have to pay advance tax in 4. They have to pay only one installment, that is on 15th March. That's 234B interest. Actually, 234B interest starts from 1st April of the assessment year. If you have already paid your advance tax, then 234B will not be applicable. Even 234B says that even if you pay 90% of your advance tax liability, even if you pay 90% of your advance tax liability, then 234B will not be attracted. But if you don't even pay your 90%, then whatever is the short amount from 1st April onwards until you pay it, then 234B interest would be applicable at a rate of 1%. So this was 234B. Okay, it's 11 now. Last chapter for the day, return of income. See, 139(1) is an important section. It is a general section for return of income. So any person whose total income exceeds the basic exemption limit is required to file the it's required to file the return of income on or before the due date. So you understand what is the due date. 30th November is not in our course. Generally, 31st October and 31st July is the due date. For whom it is 31st October. For all companies are required to file their return of income up till 31st October. Other than company who are required to get their books of accounts audited, for them also it is 31st October. And if there is a partner of a partnership firm, whether they are working partner, non-working partner, does not matter. So if they are a partner of a partnership firm whose firm is required to get their accounts audited, so see, firm return will also be filed by 31st October. Partners return will also be filed by 31st October. I'm again repeating, company assessee 31st October. Any other assessee who are required to get their accounts audited 31st October. Partners, working, non-working, both. Partners of a firm whose firm is required to get the accounts audited, firm return will also be 31st October. Partners return also will be 31st October. And if it is any other person who are not covered here, for other it is 31st July. Got it? So we have to submit our return of income up till this date or this date, as the case may be. 30th November is not in our course. So who are required to file the return of income? Every company, every partnership firm have to file the return of income. Other person have to file the return of income if their total income exceeds basic exemption limit, that is 3 lakh in default regime, or in optional regime 2.5, 3 or 5 as the case may be. And this total income we will see before chapter 6A deduction, before chapter 6A, before these sections 54, 54B, 54EC, etc. if your total income exceeds the basic exemption limit. But most important thing is this. Please remember this. So this is the question they can ask you, that what are the conditions other than the total income when we are supposed to file our return of income? See, if you have deposited more than 1 crore rupees in the current account, or if you have deposited more than 50 lakh rupees or more in the saving account 50 lakh, current account 1 crore. So if the person has deposited this much amount, more than this amount, then they are required to file the return of income. If their electricity bill is more than 1 lakh rupees, then also they are required to file the return of income. If they have actually went outside India, or they have sponsored someone for the foreign travel and spent more than 2 lakh rupees, they are required to file the return of income. If their turnover of the business is more than 60 lakh, of profession it is more than 10 lakh, they are supposed to file the return of income. if the aggregate of TDS TCS, if the aggregate of TDS or TCS is more than 25,000 rupees, or in case of senior citizen, it is more than 50,000 rupees, then also you are required to deduct, you are required to file the return of income. Is this point a little bit important that you should know that what are the other conditions when you are supposed to file the return of income? Generally, you will get a theory question on this. So you don't have to write all these points, at least 4 to 5 points you can mention out of this. So I think electricity bill is little bit easy. Foreign travel, it is little bit easy. Deposit in current account and saving account is also easy. Got it? If you don't file your return of income on time, then there is a fees of rupees 5,000 rupees. That is fees for default in furnishing return of income. But if the total income does not exceed 5 lakh, then the fees would be 1,000 only. If the total income exceeds 5 lakh, then 5,000 is the fees. If the total income does not exceed 5 lakh, 1,000 is the fees. Return of loss. This return of loss is same like normal return. The only thing is that it is a negative return. So if a negative return is filed up to the due date, it is called return of loss. That is called a loss return. And you have to submit the loss return also, because if you don't submit the loss return, the losses under the head PGBP, the losses under the head capital gain, owning and maintaining resources will not be carried forward. However, house property losses can be carried forward, but only under optional regime. I have already told you, in default regime, you can't carry it forward. Belated return. Can the return can be filed late? The answer is yes, return can be filed late. 3 months before the end of the relevant assessment year. 3 months prior to the end of the relevant assessment year. So let's say, for example, our previous year is 24-25 and our assessment year is 25-26. So it is ending on 31st March 26. This is the end of the relevant assessment year. Before 3 months before this, so we will get 31st of December 2025. So we can file the return of income up till this date, up till 31st December 2025, or before the completion of assessment, whichever is earlier. The same way we can revise the return also 3 months before the end of the relevant assessment year, or before the completion of assessment, whichever is earlier. Last point is updated return. Updated return. Can we actually submit our updated return? The answer is yes. What is the time limit of updated return? See, if you have not submitted your return earlier, or in case you have submitted your return earlier, if you won't like to update it, why you want to update it? Because the time limit of belated or revised return has elapsed. Now still you want to update it, then we will give you some extra time. So updated return can be filed within 24 months from the end of relevant assessment year. What does it mean? That let's say our previous year is 24-25. Relevant assessment year would be, assessment year is 25-26. What is the end of this assessment year? 31st March 26. After this date also, we will get 24 months. That is up till 31st March 2028, we can file our updated return. So this is updated return. We can file up to this date. So you should know the date up till when it is filed. And there are a few important points about updated return, which is very, very easy. Updated return cannot be a loss return. It will always be a positive return. In case your original return was a loss return, here this return should be an income return. So it should be an income return. You cannot, because updated return is more for the benefit for the income tax department. It is not for the benefit of the assessee. So if you have an income before, and now if you want to reduce your income, you cannot reduce it. You can only increase your income. You cannot reduce your income. You cannot claim refund from updated return. So if in the earlier return there is a refund, now your refund cannot be increased. Your refund cannot be increased. You cannot decrease your tax liability. It means that whatever the income you have shown it earlier, you cannot reduce it. So this return is actually more for the benefit of the department. It is not for the benefit of the assessee. And once return is updated, you cannot further update it. You cannot further update it. And if your assessment is already pending under appeal or under any court, then you cannot file the updated return for that year, because your case is already with the court or any appeal, etc. Then you cannot file your updated return. Last point is that how much tax you have to pay, how much tax or interest you have to pay on updated return. See, on updated return, you have to pay tax also, interest also, late fees also. Plus some additional tax also you have to pay. Additional tax also you have to pay in updated return. How much is the additional tax? See, you have 24 months. From this date, you have 24 months to file your updated return. If you file your return within 12 months, in the first 12 months, because you have 24 months, but if you file your return within first 12 months, then you have to pay additional tax 25%. But if you file your return in last 12 months, then 50% would be the additional tax. And this 25% or 50% of what? Of tax plus interest. So of tax plus interest, 25%. And if you are filing it after 12 months, because you have 0 to 24 months to file. So if you file in first 12 months, 25%. If you file after this 12 months, means 13 months to 24 months, 50% of tax plus interest. This is the additional tax which you have to pay. Okay. So this was the end of the revision which I have to take. Initially, I've planned it that I would be taking it around 6 or 7, but I think that I've taken some more time in explaining some provisions. Although most of the things I have not explained it, I have just read it and able to just cover up those provisions so that you can recall them, because we have already done in our regular lectures, in fast track lectures, in practice batches also. We have done it in detail. So I believe that most of the provisions that you are able to know, that is now you are just able to recall all the provisions. Guys, please take rest now. Take rest. In the morning, you can wake up around 6 or 6:30. Then you can study for next 3 or 4 hours. Then please go with a fresh mind. Go with your fresh mind. I'm also very tired now today. So go with fresh mind. Farewell. Maintain your speed from the very beginning. Maintain your speed from the very beginning. First, do not pick total income question. First, do not pick total income question. I would request you to pick GST first. Try to complete it before 1.5 hours. Try to complete it before 1.5 hours. Give more time to income tax, give less time to GST. But I'm not saying if somebody would be taking 1.5 hours also for GST, that is also fine. But still try to manage to complete this GST in less than 90 minutes. Less than 90 minutes. Okay, first pick up GST, then pick up your income tax. For income tax also, I would suggest that first do not pick up your total income question first. First pick up your other questions. From question number 2, 3, and 4, you have to select any two questions. So just select any two questions, first pick up them. Please maintain the speed from very beginning. Then after that, you should have around 40-45 minutes for your total income question. Then please pick your total income question at the last. But again, I'm telling you, please maintain the speed from the very beginning. Thank you so much. Bye and take care. And soon see you in finals.